This event is supported by the UK government's ASEAN Low Carbon Energy Prosperity Programme in partnership with Ernst & Young. And this conference would not be possible without the support and hard work from CIMB, SME Bank and Zurich, and without the help of our knowledge partners, Climate Governance Malaysia, WWF, FIDE Forum, Swiss Re, Fair Finance Asia, AFI, and IBFIM. My name is Russell Marsh. I'm a director at EY Singapore and the Green Finance Lead for the UK government's Low Carbon Energy Programme. And I will be your MC for this afternoon's segment. Some of you may not have been present this morning, so please allow me to share a bit about the JC3. The JC3 was formed in 2019 and is co-chaired by Bank Negara and Securities Commission Malaysia, with members comprising senior officials from Bursa Malaysia and 19 industry players. The JC3 is set up to pursue collaborative actions for building climate resilience within the Malaysian financial sector. Before we kick off, let me just make some housekeeping announcements. Firstly, please note that the conference will be recorded and replays will be available on the IBFIM website. Microphones for audience will be disabled, but please do submit your questions via the chat function in WebEx, and we will pick the questions up as we go through this afternoon's session. We will be using the poll function at points throughout the session, so please do keep an eye on that and please participate in the polls when they are flashed up on the screen. And if you've experienced any technical difficulties, please drop a message into the WebEx chat window to the host. We would recommend that to get the best experience of viewing this WebEx that you tune in via a desktop or a laptop and ensure you have minimal other applications running. And finally, I'd like to ask you to engage in this discussion on social media using the hashtag #FinanceForChange. So this morning, you may have heard messages from the naturalist Sir David Attenborough, Governor of Bank Negara, and the UK Regional COP26 Ambassador for the Asia Pacific, Ken O'Flaherty. And then we followed that with 3 panel sessions outlining why and how you can begin your sustainability journey. This afternoon, we have divided the agenda into 5 different breakout sessions to go into deeper dives into significant different segments of the finance industry. You're in the segment focused on topics related to consumer banking, and we have industry experts from Rabobank, Bank Islam, UNEP FI, BBVA, Colonial First State, CIMB, and EY to talk about sustainability in consumer banking business. So please do, as we go through today, share what you have learned on social media using the hashtag #FinanceForChange. So going to move now into the first session of this afternoon, and this will be a presentation entitled Examining the Past and Visualizing the Future. This will be delivered by myself and my colleague from EY Malaysia, Arina, who is a partner in climate change and sustainability services. We also have Suzanne Biegel, the founder of Catalyst at Large and an expert in gender smart investing, to provide insights in how gender issues relate to climate. This presentation sets the context for this focused session by talking about general sustainability risks and impacts to the financial sector, adapting business models to sustainability, sustainable finance opportunities, and aligning and setting 2030 sustainability commitments, amongst a few other things. This is a common session which has been delivered in parallel to all the other breakout sessions at the moment. So therefore, we've had to pre-record it to provide everyone with the same content and experience. So now I'll hand over to run the presentation, examining the past, visualizing the future. Thank you.
My name is Russell Marsh, and alongside my colleagues Arina and Suzanne, I will be presenting for you this afternoon. So firstly, the three speakers you hear from this afternoon are myself, Russell Marsh, and I'm a director at EY based in Singapore. My colleague Arina Kok, who's a director at Ernst & Young in Malaysia, and Suzanne Biegel, who's a founder from Catalyst at Large and a co-founder of Gender Smart Investing. So today we'll be covering an overview of the general sustainability risks and what that means in terms of impact on the financial services sector, how business models need to adapt to reflect that sustainability, and particularly looking at opportunities for sustainable finance, aligning sustainable finance to national 2030 commitments, looking at how you integrate governance and management in terms of looking at sustainability, looking at enablers of sustainability change agents, and then finally, gender and climate investment. So firstly, and I'm going to lead this part of the session this afternoon, just looking at what are sustainability risks and how do they impact on the financial services sector. So firstly, what we're seeing is a range of activities that are creating pressure on businesses to increase their focus on sustainability and ESG. And I think it's pretty clear now that sustainability and ESG is no longer an option, but it's a necessity if businesses want to stay relevant. On this slide, we just outlined a number of those pressures that are changing and coming to businesses, and particularly the financial sector, and why they need to start really taking into account ESG and sustainability. And that's both in terms of the first one on that slide, in terms of the science, in terms of changing with the warming world, so in particular in relation to climate change. That's leading to increasing prominence and focus on the global agreements for climate change and getting countries to take on increasingly tighter targets for emission reduction. You've then got national governments increasing their regulations around how financial institutions and corporates more broadly should take into account a focus on climate change in particular, but broader ESG. They've now got an increasing demand for non-financial information from investors, all looking to understand the ESG impacts of their investments and asking those companies that they invest in to provide much more non-financial information and much more ESG investment and data as part of their decision-making processes. And we're seeing consumer behaviour changing. So consumers are starting to demand more products that provide a more positive impact on the environment and more sustainable products. And so we're demanding that through their purchasing, that they're starting to look at these, adapting to and buying these kind of products. So looking particularly right now, we're obviously in the middle of and hopefully coming out of the COVID-19 pandemic, but the onset of the pandemic and this increased focus on climate change has really highlighted the importance of ESG in investment decisions. And looking at the stats on this slide, what it's showing is how investors are viewing a number of these ESG issues. And it's clear that majority of investors are really starting now to look at a whole range of ESG issues, whether that's climate risk and natural resources, whether it's gender diversity, whether it's evaluating companies' non-financial performance. There's a range of different factors that investors are now looking at when they start looking at their operations. And you can see that that has grown over the last couple of years in terms of that slide on the left of that slide, showing the percentage of respondents in the survey, how they looked at things like environmental, social and governance risk, and that's dramatically increased from 2018 until 2020. And taking that a little bit further, we've now seen that the top identified global risks have shifted very much now towards focused on environmental, social, and ahead of economic factors. And this is a study that was done by the World Economic Forum. It's looking at this global risk report. So if you look at the difference between the top 5 risks on the left and the top 5 risks on the right, it just shows how now extreme weather, climate change, natural disasters are much higher risk than some of the economic risks that were at the top of the list in 2010. So that's just a clear indication of how global risks are being looked at and how climate change in particular is now seen as a significant risk. And looking at that again in a different way, this is another similar graph from that report from the World Economic Forum in terms of global risks, and showing that the climate action failure is identified as the risk that have the greatest impact and is the second most likely long-term risk that's been identified. And what we've seen, in terms of the global pandemic, we've seen what happens if you ignore long-term risks of things such as pandemics. And obviously the goal now with the pandemic is to reduce harm while waiting for a vaccine. However, there is no vaccine for climate change, so we need to take action on climate change very differently to how we're dealing with the pandemic. And the other thing to recognise, obviously, is economic activity has bounced back after the financial crisis, and that's starting to see emissions increasing. And so we're going to look at how we can grow the economies, but as we emerge from the pandemic, but without having that similar impact on global climate change emissions. Also seeing climate change impacts are now emerging much more quickly than anticipated. And on the left, just highlights a number of the measures and impacts of climate change. And it's showing that we're starting to see all of those increasing much faster than had previously been seen, whether that's ocean heating, sea levels rising, or the Greenland ice cap melting. And that's leading to things like greater income inequality, higher food insecurity, and increased urbanisation as people have to move away from areas that are going to be subject to coastal flooding in particular. So then looking at, what does that mean? So how does climate change, how do those natural impacts of climate change end up becoming a source of economic and financial risk? And what this slide does is look to just summarise that at a reasonably high level. And what we talk about is two things. We talk about physical risk and we talk about transition risk. So the physical risk is the risk by an actual natural disaster event, so like an extreme weather event, what that actually the impact that can have on the financial sector, again, in terms of having to build back that infrastructure that's destroyed, that's a definite risk and a physical risk on the financial sector. And then you've got transition risk, and this is the risk to corporates about having stranded assets or this move towards a lower carbon economy. So an increase in policy and regulation from governments, emerging technologies that take over because they're low carbon, taken up by the market, and general market sentiment. Again, we talked earlier about how you're starting to see a number of drivers on companies to move towards incorporating ESG considerations within their operations. And if companies don't respond to that, so they can end up, say, having a big financial impact as the products they provide are no longer wanted by the market, or to say the products they produce are impacted by changes in policy and regulation. If you're thinking particularly about the energy sector, obviously as governments increase their focus on reducing carbon emissions from the energy sector, if you've got a high carbon intensive energy sector, that can be a big risk in terms of the speed at which some countries are taking that transition to a lower carbon energy sector. And looking at that a slightly different ways takes us a little bit further. Is okay, how do we see those climate change effects come through in terms of the economy and financial stability? And looked at, say, both again from the physical risk drivers and the transition risk drivers. Where you see, as a result of physical risk, you see this business disruption, you might see capital scrapping, and that will lead to potentially lower property values, lower household wealth, and that can have a link through to the financial system in terms of financial market losses, credit market losses, etc. And then similarly on the transition risk, where you're seeing changes in climate policy, change in technology, change in consumer preferences, you could potentially have stranded assets in terms of fossil fuel generation technologies, some real estate infrastructure, etc. And that can lead to corporate asset devaluation, low corporate profitability, etc. And then have lead to financial market losses. Then there's obviously feedback loops within that in terms of the financial contagion through market losses and credit tightening, feeding back to the economy. So what you've seen there is at a relatively high level how, in particular, climate change can have a direct impact on the financial system and a direct impact on the economy, and therefore, how businesses broadly, and financial sector in particular, start thinking about how can it adapt its business model to respond to that challenge, and in particular also thinking about the opportunities. So what this does is look at, again, how does sustainable finance, what does sustainable finance mean for the full business model of an institution? And what this slide looks to do is say, try and look at, say, across the whole of the operations of a business, what's their role, what's the impact of this continued focus on ESG and sustainability and sustainable finance on that company. And that's everything from so you've got the business implications and challenges on the left. You've got, in terms of shareholders, you've got change shareholder goals. We're starting to see increasing shareholder activism, where you've got shareholders who are looking to really change the internal process of the company and get it to take on higher targets, particularly for climate change emissions, through using its ability as a shareholder. We're starting to see new investment products coming out into the market. You've got new terminology, new regulatory requirements for you to understand, and how you can embed those within your risk management system. You're going to have new and changed risks. So the risks that you're facing now and the risks you might face under some of the scenarios for climate change could be quite different. So you need to understand how those risks are changed and how that fits within the company. You may start to see change policyholder behaviour, changed employee behaviour. Again, employees looking to see their company do more in some of these areas. So how do you respond to how employees are starting to view these issues? Your business partner behaviour. Again, working with a lot of businesses. What are they doing? How are they changing their behaviour? How are they responding to these demands? I think also looking at product innovation. It's not all risk. It's also looking at these new market opportunities. Particularly look around in terms of, say, the energy transition, moving towards a lower carbon economy. The amount of investment, the amount of new technology we're going to need to meet some of those targets is huge, and that's where there's real opportunity for companies to start looking at where they are now and where the opportunities are in the future, and how they can start to move towards embracing and taking the benefit of those new opportunities. And this looks at this a slightly different way in terms of looking across different parts of how this transition, these strategies for sustainability works across different parts of the organisation. So you've got, say, products. So we know, again, and talked about consumers continuing to demand more ethical and sustainable practices and products, and again, being able to have products that meet that need. Within internal operations, again, how can you make sure that your internal operations are becoming more inclusive and environmentally friendly, and having those internal policies that help drive those activities? So, impact investing, where FIs are now looking to invest in project companies or organisations that have some positive social and/or environmental impact. So, looking explicitly to seek out those opportunities to only invest in technologies and companies that provide this specific environmental impact, whether that's renewable energy, social housing, as some examples. Looking at distribution, again, how can you adopt sustainable ways of distributing services? So there's this US bank with its in-app voice assistant, so it provides better accessibility for banking services. And again, just to see how the distribution of these services is changing to meet the needs of retail customers in particular. Collaboration, seeing particularly in the sustainability space, we're starting to see a number of external partnerships between financial institutions to help increase and offer this wide range of integrated ESG solutions. The example put up here is about BNP Paribas collaborating with Greenly to offer some carbon tracking to its consumers through their banking app. And that's just an example of how collaborating externally can help drive a new product and innovation that this particular institution wanted to deliver. And then policy, again, how you're integrating and incorporating ESG into operations. And a number of banks and financial institutions and others are signing up to various frameworks and strategies to help align their operations alongside related ESG-related causes. I think it's fair to say that financial institutions need to do more to overcome the barriers and reap the benefits that ESG provides. And this slide looks to look at some of those. So this integration of ESG into risk management services, so really having ESG criteria integrated as part of their already risk management frameworks to help move their capital flows towards more sustainable investments. Looking at addressing gender diversity just beyond equitable workplace ethics, so looking at how you extend some of these frameworks around gender diversity down the supply chain and into customers as well. Common taxonomy, this is often the most difficult one in terms of, again, how do you define what we talk about when we mean sustainable? And sustainable practices and sustainability means many things to many different people. So having an agreement about what is a common taxonomy, what do we mean when we talk about sustainability is really helpful, and also useful to see that there's work going on within Malaysia to help try and develop some sense of what that definition looks like within the Malaysian market. Again, common standards for ESG disclosures. There's a range of different standards out there, and again, having this convergence and global guidance on sustainability standards will make it easier both for the industry to adopt those standards, but also then for the external stakeholders to be able to follow and understand what it is that companies are doing. And then elimination of greenwashing, and this comes up quite a lot in terms of being really clear that what you're doing, what you're promising to you are doing, and the consumers and others can have real confidence in that, again, the ESG claims you're making are actually backed up on what you're doing. And this is just one example, and I won't go on in this too much, because again, you can look at the slides in your own time. This is just an example of where Barclays, a bank, is focusing on product distribution, impact investment, and policy for its sustainable growth. So how it's looking across all of those issues, both, and a couple of examples we put on the slide in terms of looking at green home mortgages, looking at sustainable investing solutions. It's looked at financial inclusion for the disabled. It's looked at how it works with some financially vulnerable consumers, and it's had an impact eligibility framework, providing clear social, environmental, and inclusion criteria to track and categorize financing volume, so including labeling green and social transactions. Again, that's just an example of how this particular financial institution is looking across all of those different criteria to look at how it can become a more sustainable company and has more sustainable growth. So I'm now going to hand over to my colleague Arina to take us through the next few sections of this afternoon's presentation. So thank you very much for the moment.
Thank you, Russell. And I'm going to kickstart with the next part. What we're going to do for this next session is really to discuss about how, essentially the finance for change can actually drive or rally, direction from all sources, as well as how does it align not just from a national 2030 commitments, how do organizations like financial institutions can drive this, and down to the granular detail of what each enablers or business unit can do. Now, looking at the next slide, when we look at what Malaysia has been focusing on, we do have a commitment to achieve the 2030 Agenda for Sustainable Development that addresses the key mega trends. So in 2021, the United Nations Sustainable Development Cooperation Framework 2021 to 2025, the UNSDCF, constitutes how the UN development system could support Malaysia's strong commitment to achieve the agenda. And it's really very much focused on the aspiration for Malaysia to become a high-income, inclusive, environmentally sustainable, and advanced democratic nation. And what this framework helps is to support, effectively collective system support for the country to address where are the bottlenecks, the trade-offs, the synergies towards the journey, and essentially to also provide the United Nations system support to strengthen the whole of nation approach to achieving these SDGs. And when we look at the diagram here, these are the 6 focus areas, as you can see, and how it's aligned to the 17 SDGs. Now, I just want to highlight that these are the key material issues where we have to actually have a targeted fit for purpose solutions that can drive multiple benefits on these areas. So when we look at the population growth and demographic change, there will be certain strategic areas that can also be addressed by the likes of digitalization, how this can actually drive certain microfinance, whether the digital banking can actually drive some solutions towards the new world order, and what are the pressure on the ecosystem in terms of, the health requirements, as well as, the food security discussions. What are the societal changes and changing face of the customer? Where we look at, infrastructures are being reconstructed and we looked at, to consider the drive of EV infrastructure or the likes of, upgrading in terms of, not just on renewable energy, but consideration of storage and CCUS. These are the mega projects of technological innovation that will come into play. Of course, the key question now is how does, finance as well as the larger ecosystem bring this change? So looking at, where the funding gaps are essentially focused on, when we look at the statistics that has been put out in place, so according to the UN conference on the trade and development World Investment Report, between $3.3 to 4.5 trillion needs to be mobilized annually to achieve the 2030 Agenda for Sustainable Development. Now, this essentially highlights the funding gap for investment, and this is where the opportunities lies in for not just the public, but also the private sector, especially for developing countries, which is estimated at $2.5 trillion. Now, the graph essentially outlines the 2.5 million, but what we want to highlight is when we look at the graph chart on the right-hand side, you can essentially see where the key gaps are in the power sector, focusing on power sector, and the climate change mitigation, transport, telecommunications, and ecosystem or biodiversity. So this is where, the focus areas, and the growth drivers are going to be, angled by most investors as well as companies on this journey. Now, when we look at examples of how financial products and services can essentially drive, or address the sustainable development goals, for all these 16 goals, including the 17 on partnerships, the focus areas essentially, when you look at no poverty, it's essentially driving finance through impact investing. I mentioned about microfinance for smallholders farmers can actually support the goals towards zero hunger. And when we look at healthcare investments, it does essentially drive good health and well-being. And this is where there are digitalization in terms of telemedicine, having the digitalization that will actually help the outreach for those underserved. And when we look at philanthropic donations to schools, it doesn't stop there, but it could also be enabled by digital education. And when we look at microfinance and lending to women and female entrepreneurs, that's where it would drive gender equality and keeping women and the underserved to actually have continuous career to support their family income. And then when we look at clean water and sanitation, this is where socially responsible funds can invest in water and sanitation, and this can also drive access to businesses as well for the underserved. And for affordable and clean energy, I think we mentioned about renewable energy investments and new technologies. For decent work and economic growth, there are general investments to real economy. For innovation infrastructure, it would be essentially relooking at how project finance or commercial can lend and integrate ESG criteria in their lending decisions, which we will see a huge significant ramp up in this year for the financial sector. And in terms of reducing inequalities, it's essentially to drive fair payments, not just for financial sector employees, but also to drive it, in terms of the investees or the customers that you're lending to. How do you then advocate for those policies? For sustainable cities and communities, it's also considering, how do you look at the mortgage lending to provide more climate resilience enablers to actually discuss on how climate risks are being mitigated and adaptation considerations. For responsible consumption and production is essentially driving the socially responsible investing. Climate action will cover in more detail, including financial ecological services that covers life below water and land, and essentially, lending to public institutions to consider for, driving peace, justice, and strong institutions. So when we look at, how sustainable finance have become urgent to achieve the low carbon economy, essentially is also looking at, how it is already impacting, if not every aspect of the economy. So I mentioned about, the connectivity, not just on agriculture, residential, human health, labor productivity, but what essentially would be key is what are the societal issues or environmental issues that has to be tackled. So these are the key questions to ask as part of the organization or as part of society is, should leadership on environment or social issues be an essential part of the purpose of the organization? What are your current engagement on environmental and social issues, whether it's authentic to your culture, brand, and your products? How do you play an active supporting role in transitioning to net zero? Every organization has its roles and responsibility, but how do you integrate this within the organization in the day-to-day operation? How does sustainability intersect or influence the business strategy and operating models? And how do you determine this climate change will impact your business model? Now, when we look at the type of sustainability commitments that can actually drive direction in the organization, these are the various areas that actually can be contributed by financial institutions. I won't go through it all because I mentioned it earlier, but in terms of the decarbonization commitment, I think there has been a lot of questions in terms of what does each commitment looks like. So we thought, it would be timely to actually just highlight here that there are various iterations of what a decarbonization commitment looks like. Here we see carbon neutral, carbon negative, net zero, and science-based targets. Having that different equation or iteration, whether does it cover emissions, is it being offset by removals, or it can be offset with science-based targets. So these are the 4 different iterations, and organizations need to then define which one works for them in order for them to consider what commitments are most reflective of their vision, mission, and their direction in the short, medium, and long-term future. So when we move on to the next part, after looking at the macro scenario, now let's get onto the institutionalizing, how do we then bring this into the organization, going to the granular detail. So when we look at the integrated governance and management approach towards sustainability, I would like to just keep the key focus in the next slide. Okay. So when we look at the governing body or audit committee and consideration internally and externally, when we look at the organization, typically for financial institutions, there is the essential 3 lines of defense. You have the management controls and internal control measures as the first line of defense, where they carry out the sustainability risk assessment when onboarding clients during pandemic review or existing clients. Now, the idea is also then apply that for environmental areas and to also engage with clients to understand their level and business plans and to consider the uncertainties. When you look at the second line of defense, essentially it's also the second part of the organization that looks at the financial controller, security, risk management, quality, inspection, compliance. How did the second line of defense actually set up their own central risk frameworks, deliver the training, develop scenarios, and undertake stress testings. And these are the part where it goes to the third line of defense, where you have the internal audit as well to review the control design and execution. What's to highlight here is this does not stop there. There is also the external audit consideration and the regulators who will also evaluate from the external viewpoint of things. Now, when we look at how this will actually change the approach, essentially learning from what the pandemic has impacted in terms of the governance, it has reinforced the importance of the long-term value approach to actually build resilience. And in terms of the drivers of the approach are pretty much the key stakeholders and the business leaders, where there are increased expectations, where organizations need to play a more proactive role in tackling the societal issues, including climate change and inequality. And you also see business leaders who now start to, have that conversation, how the CEOs and board are connecting and driving the sustainability performance strategy and targets. What's their role in driving, having a more purpose focus, to address the various key stakeholders' needs. So this essentially, outlines a research that was done by EY that actually highlights, to what extent the board has put in place the following practices. We can see that there is a growing, based on, long-term value maturity, there is a growing need to actually evaluate, what the strategies are in terms of improving the long-term value. And where we see the laggards are is essentially also considering, how do you then incentivize, the remuneration schemes to ensure that this long-term value are being driven internally and they're being compensated as well, aligned to actually ensure the longevity of the organization. So when we look at the framework, how to integrate the approach to address sustainability, typically it cuts across two aspects. One is on the strategy, one is on the compliance. When we look at the strategy governance, it is also to look at how do you drive that proactive, taking certain risks, looking into ventures, where the sustainable finance, where the risk and strategy and opportunities lies in, what are the transformative that the organization need to look for. When we look at the compliance side of things, essentially you have the board risk committee that actually looks at where the risks are, as well in terms of the stress testing, the financial capability, and where the portfolio would look like. So these are the two hats that typically would be institutionalized within an organization. There is a part where the more proactive pursuit and risk-taking side of the business, and there is the other part that is a more risk management kind of approach. But essentially, this falls within the organization, essentially, and how this is being driven is to really have that two enablers within an organization rather than just have one set up. So the eventual integration to the business functions as well as rules needs to be clearly outlined to actually drive an effective integration. So when we look at breaking down even further what the enablers or sustainability change agents are, this is where we look into the setup organizational function, where we look at where every facet of the organizational and operational structure is affected by the ESG. And we can see that from the high level to the board and supervisory board level, you will then need to consider now in terms of the how the board drives sustainability strategy, performance, and targets. You will also consider how the board risk committee will actually evaluate risk, but you will also consider now for remuneration committee, how do they connect the performance of the board and senior management as well. So this is where the high level set infrastructure would be before it's trickled down to the next core process as well as the supporting process. The core process, essentially, when we look at product management, it would be looking at the various sustainable investment. How do you consider the green and brown assets and greenwashing? Where you talk about marketing, there's also market position. Where do you communicate your performance? How do you manage the engagement with your internal and external stakeholders and the regulators as well? And in terms of the sales, is essentially to drive, what are the financial advice that you're going to give to your investees, as well as to your customers, coming up with various products that actually fit their needs, and considering whether is there opportunities to drive new technologies as well in terms of sales. And in terms of processing and handling, there is the discussion of the conflict of interest, taxonomy, what's the use of funds, and when you come to customer service, it's essentially how do you handle the grievance mechanisms, the complaints and the governance structure. So when we look at the support processes, these are essentially where the other parts of the functions of the organizations is the legs, the arms, the heart that actually need to also rally together. This is where you see in terms of the laws, the regulatory affairs, the finance, the compensation incentives needs to now come together to actually see how they can actually consider the advancement or the components of ESG into how they actually operate, incentivize, provide legal advisors, handle the business operations, whether when you look at asset management, how effective are the assets and how resilient is it towards flood, climate risk. So these are things that needs to be considered. I will move into more detail when we talk about these aspects. When you look at integrating sustainability into procurement, what we see now is essentially the drive on improving global human rights situation, and as well as fostering the UN SDGs. So it's also considering, what are the greater responsibility to contribute to climate protection, material efficiency, what are the social standards and good governance that needs to be driven in the supply chain management, as well as, when it comes to risk mitigation, how do you ensure the security of your supply chain? How do you maintain the license to operate through management of ethics and regulatory framework? But when it comes to, what sustainable procurement really means is essentially to have clearer transparency, have a clear monitoring material sustainability risk in the value chain. And what we have seen is most organizations are starting to come out to see how they set the standards for their sub-suppliers. They would evaluate and say that, how many has been, not meeting the standards. Hence, therefore, they are being coached or they're being advised on how to enhance, the supply chain standards as well. And when we look at where the opportunities lies, essentially is to drive profit in terms of efficiency, accelerating the sustainable business solutions, to actually handle significant perception. How do you position in the market for transparency in your supply chain management? And to essentially also grow and drive the performance, attracting new talents, ensure customer satisfaction, that you are essentially the brand to come in together and be aligned with. Looking at, in terms of building facilities and management, the consideration is the need to actually plan and mitigate physical risk on your buildings and facilities. We had the flood in January, a massive flood, and a lot of operations and branches of financial institutions are impacted by flood. The question then is, how has those been factored in and considered? And when talk about, energy, carbon, and environmental taxes, how do you consider that as well, impacting your transition risk? And in terms of smart building and energy efficiency, we're seeing quite a number of retrofit being done on buildings, and the shift to renewable energy, putting solar rooftop panels, and as well as driving a lot of energy efficiency with automation in the smart building elements of the operations. So in terms of occupational health and safety with the COVID, there's also a need to have the awareness, well-being, and there is a discussion as well on driving mental health and well-being concerns, especially in the lockdown situation. So what building and facilities management needs to have in terms of consciousness is really to invest in green technology and assets, consider what are the ways to actually coordinate the carbon footprint and energy audits of the assets, and what are the environmental health and safety considerations in the supply chain when people visit your facilities and building management. Where the opportunities are essentially with all these automation, it can actually optimize energy, carbon, and environmental taxes. And essentially is also to drive and reduce exposure to environmental disaster. You can actually help to actually drive renewable energy where it can be managed in a larger scale, and as well as handle the facilities for effective employee management. So when we look at integrating sustainability into human resources, what we see in terms of the drivers and trends are the digital and technological advancement in having better digital tools to enable the mix of on-site and remote working, which is quite critical in this space of in the current situation of lockdown. But with that rise up in terms of digitalization, there's also concern on cybersecurity and data privacy. There are also discussions about the issues surrounding digital inequality and social fragmentation, driven by educational disparities, unemployment, and gender and inclusion issues. So this is where it's essentially the human resources can also consider what the new climate economy would look like in terms of generating more jobs or new jobs, or how employees could then pivot to the new requirements of the low carbon and energy kind of low carbon economy kind of green jobs and green skill sets. So this transition is also to consider whether it can actually boost female participation to ensure a more inclusive employment landscape, and what are the new skill sets that comes with it. In terms of what sustainable human resource management would look like, is essentially to look at how they can evaluate how the mobility strategies are being put in place, incorporate the risks and opportunities capability building cut across the organization, promote gender inclusion and equality in workplace, encouraging volunteering and green champions within the organization, drive sustainability training as part of a fundamental onboarding training, provide adequate training educational opportunities to boost adaptive capacity and reduce the vulnerability of them losing jobs when we pivot, and linking, more importantly, is linking remuneration and promotional opportunities that comes with sustainability practices. So when we look at opportunities, it's essentially capitalizing the gains from remote working to actually boost morale, motivation, and contribute to sustainable business by having more efficiency, creating green new jobs, and allowing employees to pivot, it will definitely increase, the market branding or perception of the organization when you clearly drive these values and have a clear ways to actually drive transparency in how you actually mobilize sustainability considerations in the organization. It will also help you to attract talents, have a diverse talent pool, and also reduce the needs of paper consumption, mobility, travel needs in that respect. So when we look at the next part in terms of the legal and compliance, what we see is, as I mentioned, a global direction to improve human rights situation. In terms of regulatory, there is increased regulation and standard setting that actually, considers ESG management at the governance infrastructure. How these standards are being implemented, as well as how the communication are being done in an effective manner. How do organizations take responsibility on ESG management risks and opportunities? And it's always essentially as well to handle the greenwashing risk. And now we also hear the social washing risk as well coming up, and to also consider what are the risks of damage and litigation due to the externalities, climate change, and natural disasters. So what the sustainable legal and compliance would then look like is really to have that capability and competency to scan and understand what are the risks that affects the companies, to also drive, how they can operationalize and manage the stakeholder expectation. We've seen more enhancement on having a stakeholder management strategy and policies being put in place, as well as having the knowledge, of the entire legal team to be aligned to sustainability issues management, and to also regularize the internal engagement on sustainability issues. And moving on to opportunities, what we are seeing is it would help to mitigate the cost of non-compliance with any ESG laws and regulations, to also grow and improve the inclusiveness of the policies, to drive, connectivity in having a diverse talent pool, intersecting with human resources, and to manage, the transparency of disclosures and strong compliance with laws and regulations. Now, last but not least, in terms of marketing and branding, which is essentially quite critical for most organizations, is there are increasing negativity in terms of, publicity associated with poor ESG risk practices. There is also a consideration of whether there are greenwashing or essentially not having that transparency in, for example, the products that is being put in place or the green investments that you actually, commit to. So this is essentially to also understand what the customers, regulators, investors, or all stakeholders are now looking for. What are the information that they are requesting to be put forth to public, and how the COVID-19 has accelerated the momentum to have ESG being brought up to a higher increased bar of how these financial institutions are driving the force of change. And you see that in terms of the platform infrastructure that marketing and branding are using, there's also an increased online banking apps. So this will actually need to weave in the consideration of how you actually communicate ESG management. Now, in order to look at how a sustainable marketing and branding will actually evolve, there would be a clear direction to actually enhance ESG transparency, ensure that there are specific tangible commitments and goals that aligns and connect to the products and services that are being offered. And you can essentially, the organization, communicate the results and outcomes in a timely, effective manner with clear timeframes. There will also be, a significant increase on how do the organizations educate customers on the benefits of ESG products, as well as embrace the digitalization to provide the enhanced value as well. Of course, when you look at the opportunities, it would help to actually enhance your market positioning. When you offer measurable results to support your commitments, you are also able to then look at what are the various avenues of customer satisfaction that you actually can capture. And most organizations we see in the market who are leading on marketing and branding, they start to put out in place how strong do they evaluate their relationship with key stakeholders. So this is where the strength and the surveys and evaluating the stakeholder management strategy comes about, and how do you then inform that results to the public. So with that, I will pass on to Ms. Suzanne Biegel, who's the founder of Catalyst at Large Expert, to actually take us through the Gender Smart Investment chapter. And over to you, Suzanne.
Good afternoon, all. I'm so delighted to be here to speak with you today as one of the technical partners for the ASEAN LCEP, and I want to thank EY. My name is Suzanne Biegel, and I'm the co-founder of the Gender Smart Investing Summit, a global initiative to unlock gender smart capital at scale. And today I'm going to speak with you about the nexus of climate and gender finance and the urgency and importance of bringing these two themes together. And I'm going to be pulling from our report, Gender and Climate Investment, a Strategy for Unlocking a Sustainable Future. Next. Let's get started by talking about the context for the growth of the field, the urgency of why it's so important to consider the nexus of gender and climate finance, and dive in. Next. You've already been speaking about climate change, climate finance, but most climate finance is not yet gender smart. Next. There's a huge demand, of course, for climate finance to facilitate and accelerate the transition to a low carbon economy and a resilient economy. And at the same time, we need to be conscious of how climate impacts different communities disproportionately. The poor are especially vulnerable to the effects of climate change, and the majority of the 1.5 billion people living on the planet under $1 a day are women. Gender-based differences in women's and men's vulnerability, as evidenced by mortality rates and extreme weather conditions caused by climate change, stem from gendered norms around mobility, skills, employment, and other factors which limit women's participation and access to resources and economic opportunities. But we must not only see women as victims of climate change. Tackling gender inequalities can positively influence climate action. And as a study from the IMF shows, policies that improve access to educational opportunities and finance for women can lead to a reduction in not only inequality, but an increase in economic growth for the developing country. One Brookings Institution study suggests that for every additional year of schooling a girl receives, on average, her country's resilience to climate disasters increases. Why is this? Because she can make educated decisions about sustainable choices and preparedness, resiliency. For example, an educated farmer can make different crop decisions and financing and irrigation. Next slide. Finance can deliver enhanced climate and gender impacts, but beyond this, climate and gender investing is just smart investing, period. And by bringing these lenses to bear on investment decisions, we see the potential for increased returns and decreased risk. And we've articulated 5 reasons. This is not a hierarchy. We believe these are all important, but these are some of these are more relevant for others in looking at different investment actors and actions. First, integrating climate and gender investment approaches can help to uncover new investment approaches. Women innovators and entrepreneurs are creating disruptive solutions, and addressing gender in a product or service solution can unlock products and services that are more responsive to market needs. It's also about mitigating risk. Climate risks cannot be diversified away. They affect all businesses, whether directly or via customers, suppliers, and communities. And failing to address gender can be a source of market risk, operating risk, or even reputational risk. Companies or funds may fail if they brush off the gendered needs of employees or customers or suppliers or other stakeholders. And gender smart and climate smart investing provides ways of mitigating those risks. It's about meeting investor expectations. It's about driving long-term value, because a gender and climate lens can drive competitive advantage and long-term value across talent, innovation, markets, products and services, value chains, and governance. And as climate and social impact enter mainstream thinking, regulation, and policy, those who fail to adapt at risk falling behind. And finally, of course, amplifying social impact. Looking at gender equality and climate action cuts across so many other SDGs, and all development finance, and indeed all finance with the SDGs as an objective, is beginning to recognize that gender is a cross-cutting theme. We believe that long-term, there'll be a correlation between these companies driving positive social returns and having an increased impact on financial returns. Next slide. I want to share this quote from Mark Carney, which you can read yourselves, the UN Special Envoy on Climate Action and Finance and former governor of the Bank of England. Mark Carney is an international gender champion who is pledged to champion the use of the 2X Gender and Climate Task Force tools on climate and gender, and to champion better access to climate risk training opportunities for central banks and supervisors, particularly in emerging markets and economies. Next slide. Both fields are growing fast. I don't need to tell you about the growth of the climate finance field, but I will tell you about the gender lens investing field. We estimate that by the end of 2020, there was more than $18 billion in public and private investment vehicles moving with a gender lens. And this chart illustrates the growth of those vehicles. And these two areas of climate and gender have tended to operate in silos, but the integration of the two can unlock tremendous opportunities. So we ask ourselves, what if all of the capital flowing into climate finance today had a gender lens? To build a realistic picture of the opportunity to bring these together, critical data gaps are there, we recognize that, but we have the opportunity to be carving out new solutions and examples across ASEAN. Next slide. I'd like to take a second to highlight the ASEAN region as an example of a way to bring together gender and climate. The East Asia and Pacific region is the largest provider and recipient of climate finance globally, with 250 billion USD, comprising 44% of total flows. And gender lens investing is up 160% in ASEAN, with 22 active gender lens investing vehicles across public and private markets at a total of 1.1 billion USD. In addition, annual flows of 250 billion into climate-related projects represent a huge opportunity to significantly scale up gender lens investing in the ASEAN region, although it hasn't happened yet, through ambitious gender-related KPIs being intentionally integrated across all climate finance by default. And some of the public capital providers have made some commitments in this regard, but to date, this opportunity really remains largely untapped in the ASEAN region. But it presents a significant opportunity to be a leader, both for women and for the world, and for climate outcomes that we're really looking for. If you go to the next slide, I want to talk a little bit about some of the principles around applying these lenses. Next slide. So this is about bringing together a climate and gender lens together, not only in what we're investing in, but who has a seat at the table, and what kinds of companies, what kinds of funds, what kinds of ways this comes out in an infrastructure project, and where financial institutions have a role to play. There are a few different ways to think about this. One is to apply a gender lens to climate finance, existing climate finance, and to think about how do the company's products and services or value chains really impact the lives of women and girls. You can also apply a climate lens to gender finance, so thinking about where gender bonds, gender-specific investment vehicles are, and think where are the green opportunities within those opportunities. And then really thinking from the very beginning to bring gender and climate together, are there gender-specific opportunities to improve climate and business performance? And what would you look at? You would again look at leadership, you would look at governance, you look at supply chains and employment, you'd look at customers and communities, and you'd be thinking about where might I be spotting an opportunity by paying attention, or spotting an opportunity by spotting a risk where I'm not paying attention. And I'll get into that a little bit more. Let's go to the next slide. The key actors in this ecosystem are, of course, all of the finance providers and capital providers, from the central banks, the DFIs, foundations and family offices, the fund managers, but the intermediaries, the coalitions and networks, the consultants and advisors that are bringing these kinds of products to market, and the movement building actors. And then finally, of course, on the company side, to really be looking at businesses across ag, across energy, across transport, across manufacturing, circular economy, sustainable cities. And I'm going to talk a little bit about how this comes to light in that ecosystem. If we go to the next slide, money's already moving, and pioneer investors are leading the way here. So the DFIs, there's a set of DFIs that have collectively committed 15 billion in capital to move with a gender lens and significantly as well with a climate lens. In 2018, they made a commitment to move 3 billion in this direction and had already moved 7 billion by the end of 2020. So this 15 billion is a new commitment. The multilateral development banks are now part of that new commitment, but they've already been acting. EBRD, European Investment Bank, IDB Invest in Latin America, the IFC, Asian Development Bank, and African Development Bank. And then funds, there are a tremendous number of funds. We're tracking more than 25 funds around the world that are already deploying climate and gender lens. And I'll talk about a few of them. And then, of course, across public markets, looking both at climate and gender in an ESG context. If we go to the next slide. So you could be thinking about this from this point of view of spotting who are those entrepreneurs and innovators that either we need to be backing through venture capital, private equity, through bank finance. They could be in corporate supply chains. It could be in public sector supply chains. It might be that it's a women-owned business or women co-founded business. It might be that it's really about women in leadership. It might be about the fact that their products and services are very focused on paying attention to women customers as well as male customers. It could be really thinking about where are women in those supply chains, again, either as owning companies or as running companies or as employees in companies. So we're thinking about all of those lenses. And if we go to the next slide, and across, as I mentioned, every area of climate finance, from energy to ag to water to transport and on. So this is not just siloed in one particular area. Let me tell you about a few case studies. Agence Française de Développement, we go to the next slide, has been working to scale up gender finance through mainstreaming gender considerations in all new sustainable bond issues. In this case, a use of proceeds bond. This would mean including requirements on gender diversity in the eligibility criteria used for the selection of projects. For sustainability-linked bonds, this would imply using an additional set of key performance indicators and sustainability performance targets in the gender bond framework, along with the environmental or KPI, the environmental or social KPIs. The integration of gender considerations in the green bond framework is a novel idea. Therefore, to date, there have not been very many examples that can serve as best practices for other green bond issuers. However, there's some promising examples. Agence Française de Développement has developed a new SDG bond framework for green, social, and sustainability bond issues in October 2020. To date, AFD has only used this framework to issue an SDG bond. Therefore, instead of a green bond, this will be used as an example of how a green bond framework can integrate gender targets. Considering that AFD has been an active green bond issuer with a total insurance side of euro 3.25 billion since 2014, we might see new green bonds using this new framework later this year. And among other eligibility criteria, the bond framework requires new projects and loans to receive a neutral or positive grade in 6 sustainable development dimensions, which include gender equality alongside climate objectives. So we're thinking about access to services, control over resources and income, access to justice, combating violence against women, participation in economic, social, and political decision-making bodies, and project governance with regard to gender. If we go to the next slide, Schneider Electric, a French company focusing on energy management and automation, can use the proceeds of their sustainability-linked bond for general corporate purposes. And at the same time, it has a strong incentive to meet the SDGs that is committed to in its bond framework. If it doesn't meet its minimum KPI score threshold by 2025, there'll be a margin step up or a premium payment as outlined in the transaction document of each issue. And the KPI minimum score threshold represents on average an 85% achievement for each KPI, which corresponds to an average score of 9 or 10. This is calculated by first giving a performance score to each KPI on a 10-point scale. The equal weighted average of the scores for the 3 KPI determinants determines whether the KPI minimum score threshold has been met. And Schneider's example to show how you can integrally link a gender KPI, a climate KPI, and a training, an employment KPI is a model that you can really look at. Next slide. There's no single path to an integrated gender and climate investment approach, but the risk of waiting for the perfect opportunity or data or project outweighs the benefits of acting now, whether testing the waters within pilot project or scaling up what it is to be done. So I hope this has given you a little bit of a flavor for how we bring gender and climate finance together, and I wish you good conversations this afternoon.
Thank you for that. So thanks to my colleagues Arina and Suzanne for joining me in providing that overview. And I do hope you have found that a useful overview into effectively where the finance sector has come from and where it is going to. So I do hope you found that useful. I will now pass straight over to our next speaker, which is Bas Rüter, who's from Rabobank. He's the Director of Sustainability at Rabobank and also heads the sustainability platform of the Dutch Banking Association. And alongside that, he's a commissioner or board member of a number of other organisations. Bas is going to talk about how we define sustainability in retail banking and the design process to creating positive impact in retail banking through adding environmental and social benefit. And he'll provide some real life examples of how a green or social product was conceived and launched and how the impact was measured. So I can see Bas has turned on his camera and hopefully has unmuted himself. I will hand over to Bas for his presentation. Many thanks.
Thanks, Russell, and truly excited to be able to speak at such an important conference today. So many thanks to EY, but also Carbon Trust and IMC Worldwide as important contributors to making this all happen. Many thanks also for everyone listening and looking actually to be able to discuss a little bit about sustainable banking in the retail domain. I will do so with the lens of Rabobank. And a little short introduction on Rabobank, maybe next slide. We are not only committed to sustainability as a regular part of our business strategy, we've really made it into the central theme in our mission, which is growing a better world together. And that's not a coincidence, because Rabobank is a cooperative bank and is 120 years old, is focusing on food and agriculture financing worldwide, and is a market leader on all markets except one, the high-end private banking market in the Netherlands itself, which implies that food and agriculture is an important part of our identity and is also an important part of social challenges we face in the decades to come, including feeding the world sustainably, and at the same time interlinked strongly with, for instance, the climate and the biodiversity challenges we face as a society. And you see that back in our strategy, and you see that back in the day-to-day service offering we deliver. Today, I want to tell a little bit about our strategy. How do we actually turn that into practice? And show you a few of the practical examples that we have designed and currently run in the market, and also how that is perceived by our clients. If anyone has a question, please use the chat. I'm totally open to see if I can interlink it with my presentation, and if not, we'll take notice of the remarks and the questions at the end. First of all, it's important to highlight that we live in an important age. I would say today society is actually facing the challenges of a number of SDG-related topics at a pace not seen before, at a magnitude not seen before. Sustainability as a result is an important topic, both for our clients, for society as a whole, but also, for instance, if we look at the way supervisors look at us. So everyone is talking about it. And this rapidly changing environment is an environment in which we feel comfortable, because historically we have been a front runner in sustainable banking, which is marked by the #1 rating in Sustainalytics for the over 300 large financial institutions operating worldwide that they look into, and in a number of other ratings. But we intend to stay that front runner. And in order to stay a front runner in an era that is changing so rapidly and in which sustainability is so important, you need to be ever more transparent. People don't trust banks anymore on their blue eyes. They want to see proof. And that's an important topic that we take serious in our reporting, but also in our consumer communication. In addition to that, on transparency, we have said that these times require a different approach. And a different approach means that the ambitions need to be higher. And in order to be able to deliver on it, we need to really integrate sustainability in the core of our business, in the areas where that has not yet been the case. And we truly need to integrate it into our performance management cycles. And that is what is currently going on. The strategy was designed in 2019 for the era until 2025, and we are currently rolling that out rapidly. Important is that we used to think about sustainability as a topic that was actually managed by my own team, sustainability department, and we moved that to the business itself. So our commercial directors have set their own ambitions based on suggestions of topics made by us. They have defended that in the managing board, and they live it every day in their own management cycle. And that has really helped to speed up the process and to integrate it in our day-to-day client servicing much faster than before. Next slide, please. Saying that that happens also implies that you integrate it throughout the relevant parts of your business. And I just want to show you this slide and how we build this up today. I think it all starts with regulations. Only over the last 24 months have we seen that 44 new laws have been issued in Europe alone on sustainability and climate. And we, of course, need to comply with those and implement it in our day-to-day servicing on a daily basis. That is where it all starts when it comes to compliance. But we want to truly integrate that with the mission. And as a result, we have made voluntary commitments, for instance, the Paris Agreement, and not just our own business, but also helping our clients to achieve those goals. We've converted that into our sustainability policy framework, which provides the rules of financing, relatively concrete and relatively detailed in comparison to our peers. And that is the guidance for our bankers on a daily basis. In addition to that, we've got a climate program in place, and we actually expect that the topic of biodiversity will be added to that relatively shortly, given the priority it gets in society as a whole together so rapidly, and the fact that we're a financial institution. We've also expect the ESG topics that are required by the European Banking Association for the provision of loans to be integrated in every detail required in a relatively short time as well from now, which implies that there will be a relatively large program asking for more data, and that's the light blue you see, from our clients in the different domains to steer our client servicing. That all then leads to our sustainability ambitions, and I'll say a little bit more about that later, for every business domain. And they also steer towards sector visions. And we've identified the need to not just analyze trends in the sectors we finance, but also to express our view on where those sectors should go in order to be able to live up to sustainable development goals as expressed by the UN. Having the information of the client performance using the light blue parts of the slide here, these are annual assessments of the client performance in the different domains. Understanding the vision of the sector, there is a transition path from the existing performance to our vision ideal for that sector. And in order to help our clients to get there, we've designed transition banking products and services in order to help them to jointly with us realize our mission of growing a better world together. So that's the bigger picture of how we've structured our approach internally. Next slide, please. Shortly then, what were the 5 themes that we actually suggested to our commercial colleagues to draft their own ambitions? Those were the 5 at the right-hand side. First of all, as I already expressed, we need to move from trend analysis to vision development, which implies that we really express what we think needs to be done. That's not usual for bankers, and many of you will be a banker and will understand that usually we always say that we are at the back seat while the entrepreneur and our client is the driver. We also express our opinions here more than before. Secondly, we already had a relatively short number of questions, small number of questions to identify the performance on sustainability of our clients. We've actually challenged and supported our commercial colleagues to have a more in-depth analysis of the performance and to also assess a rating to the information provided to us. So we have an annual assessment of the sustainability performance of our clients for every client who borrows more than €1 million from us throughout the world. And we also integrate that in our client servicing. And that brings me to the third point that we also see. It is great to actually enhance the performance of an individual client with the right products and services. But we also need to move it at a higher level, sometimes a subsector level, sometimes even a sector level. So for instance, we have made the choice to actually be a very large player in the renewable energy space, whereas we have a very limited exposure to fossil fuels. That is what we call transition banking at a sector level, and that is something we do on top of the performance optimization of clients. Now, in order to achieve that, we of course need to have distinctive products and services. That's also where we challenge and support our commercial colleagues. And we need, and we also do, integrate that into performance management. So the managing board members with a commercial responsibility have as their KPI set 2 KPIs that are directly related to sustainability. One, the average sustainability performance of their clients should grow on an annual basis. And 2, the relative share of products and services that steer towards sustainability and a higher performance of the client should grow annually. So those 5 themes have been the starting point for their mapping of their ambitions. And they are now in place for all commercial domains and are mirrored with the back office domains as well. So every managing board member has its own KPI set on this topic with these 5 themes worked out in detail. Next slide, please. A very short word on what we then call this transition banking, because many people ask us, what do you do and how do you select which transitions you support? First of all, it's important to understand that we have a large agriculture business. We aim to be big in the energy transition, and we have a large home retail base. And that is how we selected the 4 themes that we intend to help grow a better world together that we put at the center. First of all, the financial well-being of our clients, and that goes to a significant degree to our retail domain in our home market, where we actually help people to combine their savings for daily living, but also for their care, especially when they're older, and their pension. And that combines very well with the mortgage activities of our bank. In addition to that, we intend to play a major role on the circular economy, where we actually want to lower the use of virgin materials and to create loops in order to avoid that we deplete planet Earth, so to speak. And that is also a company-wide strategy that is very well combined with our SME domain and our wholesale domain, but also links well to our farmers. Thirdly, and importantly, the food and agri system transformation, is of course a transformation that comes too close to our heart, being an agricultural bank, and requires significant efforts in order to make sure that we provide enough healthy food for a growing population, but within the boundaries that the planet provides, both on climate and biodiversity. And fourthly, the energy transition, a clear transition everybody understands without me making more detailed analysis of it. And what you see at the right-hand side is the fact that we work very closely with the innovation teams in all the different commercial domains. And we've even set up a special carbon bank next to those domains as a separate entity to help farmers and wholesale clients to actually sequester carbon and sell that to people who want to compensate for the carbon footprint of their large company, mostly food companies. That combined with the innovation teams, with the business tribes that actually design products and services, and the sustainability managers, combines a concentrated effort on the 4 topics we see as the most important ones to influence sustainable development. Next slide, please. It's important to highlight that in order to be able to deliver on those transitions, you need to also be able to take into consideration big efforts when it comes about big topics. That's why we set aside a climate program next to the regular business, but that means with everyone from the business in a concentrated effort in a program that has 10 points that you see at the right bottom end of the slide. We have 10 activities in which the whole bank cooperates in order to make sure that we are able to deliver on our promise to help our clients meet Paris in time. And in order to deliver that, we have a dedicated group of people working on that who have the clear link between the day-to-day business, but focus completely on this important topic. This is not an easy thing. In order to be able to do so, we of course need to measure and develop targets. We need to provide solutions to help the client, but at the same time, climate risk management is an important priority. In order to be able to deliver that, people need to understand it, need to support it, and therefore training is important and the awareness raising is important. And of course, we need to then tell society what we try to do and where we stand, and also what the challenges are we face. So within the lines of those objectives, we've identified a large number of activities that has high priority next to the regular day-to-day standing organization in order to deliver. And in the next slide, I show you what that results in. So please, next slide. This year, we focus very strongly, of course, on the new legislation. But I need to say, without going in depth to all 10 of them, it is truly important to understand that in agriculture, the measurements on climate impact and in the SME domain, it is not so obvious that you already have the right data available. Not because no one agrees on what the right data are, and secondly, because not all of the relevant data are already collected. So we work with other banks today to actually design the methodology on a number of those areas to make sure we agree on what needs to be measured, and to then design tools and solutions to make our clients able to deliver that information, if possible, well aligned with their clients who also ask for the same information in order to create efficiency. Now, that important work is of course linked to new products and services, and it's linked to proper transparency on our progress, with a clear dialogue and an increasing intensity with, for instance, the central bank, who also wants us to manage these risks professionally and to be able to prove that we do so. So both on the risk and on the commercial side, the climate topic has become one of the most important topics in our day-to-day banking. This requires a lot of work. It won't be over until 2050, and probably after 2050 we will need to continue. But by making it concrete and by setting up a special program to deliver on it, we hope to be able to play that role to grow a better climate together as part of our day-to-day business. So that's on the climate side. Maybe next slide. I move on to client solutions, because I think that is what we all hope to use as the vehicle to actually deliver that societal change. Happy clients doing the right thing. First of all, having a 600 billion balance sheet, out of which close to 200 billion is a mortgage provision in the Netherlands, that is by far our largest lending business. In that lending business, we've identified a key theme called sustainable living. And it's important to highlight that that is a topic in which we, of course, have a large group of people, a few million clients who actually have a mortgage with us, with a relatively small sum of money borrowed from us in their mortgage in comparison to our commercial clients. So these solutions need to be simple. And we've designed a process in which we can actually deliver simple solutions, for which I can provide some detail on the next slide. Yeah, it's a little small, but at the bottom left you see that we have started offering a special green product, a green loan, as a part of our regular mortgage. And this is a separate loan that can be used for improving the energy efficiency of your home in the 2 years after obtaining the loan from the bank. And what we see, because these are favorable conditions, and these favorable conditions actually run over an additional 2-year period. So if you are able to actually use that money for the right measures, you will have a significant advantage. We see that currently, and that is well above the average in the market, almost 1 out of 4 clients uses this facility in their mortgage finance plan. They on average borrow €15,000, and as a result, we have been able to realize energy label A for 26% of our portfolio, which is above average in the Dutch market, even though we are a market leader. And it's important also to highlight that this 23% of people using such a green finance product is more than double than the average in the market on that topic. We also transparently monitor what the average energy label in our mortgage book is, and that's what you see at the right-hand side. And of course, we have made a very clear and concrete target, and that is that we intend to have label B on average in 2024 and label A in 2030, which would actually mean that we significantly help to realize the Paris goals in the residential living domain. We currently are at label C, so we are intending to speed up this process ever faster in order to deliver in time, which is a significant promise. Another example, maybe, next slide. An important role for us as a bank in the food and agriculture domain is the fact that in order to be able to deliver sustainable food for everyone with minimum losses, it is important to reduce that part of the inefficiency of the system significantly. If you would look at food loss and waste, it represents the CO2 emissions of the 3rd country in the world after China and the US. So it's a massive CO2 producer, and there is a significant upside in taking this seriously. So if you invest $1 in food loss and waste, you will see a business case that may yield up to $14 in return. So that is amazing. In addition to that, we think we can actually, by providing solutions for food loss and waste, create a business case for the bank itself as well and for our clients. So it has financial impact, it has social impact, and it has societal impact at the same time. I give you one concrete example on the next slide, and that is a organic supermarket chain in the Netherlands called Ecoplaza. They actually were the first customer for our loan to cut food waste, and they have an interest rate that is linked to the reduction of food waste in their stores. We all know that in stores of retail chains, a lot of the fresh food is thrown away, and they have set targets to reduce that significantly, and we have provided them a loan that lowers the interest rate if they succeed to reach those KPIs. On the next slide, you will see that that actually helps in a number of ways. It helps worldwide. When we talk about Champions 12.3, of course, 12.3 being the SDG goal 12, in order to show that things are possible if you have innovative schemes. It also helps in our Dutch agenda, where we have a large program together, which is called Samen tegen voedselverspilling, which means in English, together against food loss, where we work together with Wageningen University, with the Ministry of Agriculture, and that's also a multi-stakeholder approach. And of course, we were able to work together with approximately 10 departments to make this happen within the organization. And that also helps to raise the awareness within our organization itself. So you see concrete client solution, concrete impact, and an important role in a multi-stakeholder environment to actually contribute to the sustainable development goals. Next slide, maybe. Another example, very concrete, is the fact that we have a biodiversity monitor, which measures the biodiversity performance of our dairy farmers who deliver their milk to Friesland Campina, the dairy company, and we designed that jointly with WWF. The great thing here is that we actually reduce the interest rate if they perform well, but, and that's in addition and more important than just the interest rate reduction on our behalf, we have agreed with Friesland Campina that they actually pay a better price for the milk. And because we are able to do so, that generates a business case that actually makes it rewarding for our farmers to do the right things on biodiversity. And that in return provides us with our license to operate in the Dutch market, which is a very densely populated country with a lot of farming activity, in which biodiversity topic is a great concern for many citizens. Maybe the next slide. And that's my last example as well. We are part of the World Business Council for Sustainable Development, and we have been in dialogue with large companies in the food domain to discuss about the key challenges in sustainable food provision that they face in their supply chains. Deforestation is definitely an important part of that challenge and not one that can be solved easily. We've set up an alliance with a number of public and public-private partnerships on an international basis, including UN Environment and the World Business Council for Sustainable Development, to set up a fund, the Agri3 Fund, in which public money is made available to de-risk investments in sustainable farming practices that stop deforestation, that actually support reforestation, that help sequestering carbon in the soil and optimize soil quality and water management, and by doing so improve the rural livelihoods of the farmers involved. That often requires longer tenors that are not always available in the countries in which we operate, mostly in the south. And as a result, it is tough to get financing from regular financial institutions. Now, by working together, we've actually made the promise as a consortium to unlock $1 billion to actually make those loans available by using the de-risking facility of the fund with a balance sheet of banks, including Rabobank, but not linked to Rabobank alone. And we intend to make that happen at a massive scale, if and when possible, also copied and multiplied throughout the financial system. Now, I hope I've been able to provide you some examples of how we run our business, how we actually help clients doing the right thing by providing favorable conditions and special products to meet those sustainability targets together, and in doing so, work on our mission of growing a better world together. Maybe as a last slide, I can show you what that results in, and that's maybe too detailed to go through completely here, but important to highlight maybe at the bottom right end. You also see this back in how rating agencies, specialized agencies, see us in the financial services domain. And that again helps us to also safeguard our license to operate, but at the same time have a dialogue with our clients, but also our investors, because we do have bonds on the market, even though we are a cooperative, to finance our loan book. That actually reward this strategy in their intention and their willingness to invest in us as a financial institution. I hope I've been able to prove to you that integrating sustainability in the strategy actually works, that it also helps to create happy clients, and that it also helps to create a better world together. And I really would applaud it if you were willing to actually work with us to enhance that impact and to work together on the next steps to combine commercial success with benefits for society. Back to you, Russell.
Thank you very much, Baz. That was a really useful, or I certainly found it a useful presentation, giving some direct examples of how a bank like Rabobank is tackling and approaching this issue. And you've also done that great thing for moderator, which is kept to time, which is really helpful. So we have 5 minutes, so time for a couple of questions. And there is one in the chat. I don't know if you can see it, but I'll just read it out so that everyone can see it, can hear it. So the question is, Malaysian banks tend to have large exposure in mortgage loans. Can you elaborate what works and what doesn't, so we can gain insights and move faster in alignment with sustainable mortgages?
Yes, great question. Many thanks. I think other than what bankers usually think, and that is that price dictates everything, the easiness of actually making those measures get to reality for a homeowner who buys a house and asks for a mortgage is much more important, we found. So making it easy to do that renovation, making it easy to have more energy efficiency in your home is actually a significant part of the reluctance to do so. If you are able to solve that issue, you will definitely get the percentages much higher, as I showed to you. So what we did is actually we worked together with a small startup 5 years ago to actually test this in a small scale. Can we actually, on the basis of the publicly available data of your home, like where is it, what's the energy bill, when was it built, analyze what the expected energy efficiency is and the most efficient measures to improve your performance, and then provide the service, if you link to our system, to have people do that for you with a very concrete offer in concrete euros or dollars or ringgits, and be able to deliver that to you if and when you say yes. So make it easy, make it concrete, make it less hassle, and as a result, many more people will help, will do so using your help, which again is an interesting commercial opportunity for the bank as a whole as well. It depends strongly on the partnerships you can design to do so together, but it's a different role than we were used to. Make it easy.
Thanks for that. Thanks for that, Baz. We've had a couple of other questions come through, so I think we have a bit of a couple of minutes, so we'll try and take at least one of those questions. I mean, the first one, and this is a question that I think gets asked a lot in these sessions, is how do you motivate senior line management to pursue sustainability efforts when short-term actions may have an adverse impact on financials?
Yeah, two answers. I know a lot of short-term actions that have a positive impact on financials. So first of all, it can actually pay out on the short term as well. If we talk about, for instance, precision farming, using less fertilizer, sometimes also less crop protection, while at the same time safeguarding the same yield, you actually save money straight away. You may need to invest in a smarter tractor, or you may invest in precision irrigation, for instance. But those business cases are sometimes really convincing. So if you are able to help a client to do that, they will actually be able to have a bigger loan, and they will help you make more money on the customer because the size of the lending is bigger. That's also part of the commercial angle to the mortgage provision of green financing. They actually convert paying money to the energy company to paying money to the bank to actually pay off the loan. So there is a commercial interest for the bank very often. That's the most important one, I would say. Try to make that business case clear, because it actually pays out sometimes relatively fast. And secondly, to give you an example, in our farmers domain, we actually only a few months ago made an analysis of the sustainability performance of our worst performing farmers in comparison to the rest. So not even the best performer, the average. And they have a magnitude of 4 of the likelihood of probability of default. So it actually pays out to lower the risk by enhancing the sustainability performance. Whether that's a causal relationship or just a correlation, to some extent is less relevant. As long as it takes place, it pays out. So it may be a good farmer who happens to then also be sustainable. But if you focus on the farmers who are sustainable in your portfolio and help the ones that underperform, you may significantly often see that you enhance the profitability of the bank as well. So it's a risk management exercise, and it's actually building your book exercise. And in the end, you will get the investors you deserve. So if you see investors around you that really understand that long-term commercial success requires a strategic approach in which these elements play a role, you will have a solid investor base. If you have an investor base that will focus on the short term and will not be interested in the longer term development of your organization, you may have a tougher time selling that. As a cooperative bank, we have the fortunate situation that that is not the case. We need to convince our members, and they are convinced about this strategy.
Thank you for that, Baz. Thanks for taking those questions. I think we will need to end the session there as we need to move on to our next speaker. So once again, thank you, Baz, for joining us today, your insightful presentation and taking the questions.
My pleasure. Enjoy the rest of the conference. Many thanks.
So now we will move on to our next speaker, and I'm very pleased to welcome Muazzam Mohamed, who is the Chief Executive Officer of Bank Islam. He joined in May 2015 as the Chief Financial Officer and then was appointed to his current position in 2018. In the presentation, Muazzam will explain how sustainability and Islamic banking are similar, what some of the key differences are, and give some examples of Islamic banks that have successfully pivoted on Islamic principles to become sustainable. So Muhammad, I can see you've turned on your video and your audio, so looking forward to your presentation. Over to you.
Okay, thank you. Assalamu alaikum. Good morning, good afternoon to all participants in this conference. Thank you for having me. I am Muazzam Mohamed, and as mentioned, I'm the CEO of Bank Islam. A quick introduction. Bank Islam was set up in 1983, and we have been here for 38 years already, being the first Islamic bank in Malaysia. Bank Islam now has about 4 million customers, 4,600 employees, and 144 branches throughout Malaysia. We are predominantly a retail bank. However, we also serve the SMEs, corporates, and large institutions. Other than Islamic banking, we also have stockbroking and asset management businesses operated by our subsidiaries. We are one of the very few, I would say, true blue and standalone Islamic banks in this country, actually. And we are currently undergoing a group restructuring that we expect to complete by September of this year. And after that, we will become the first and only public listed Islamic banking group in Malaysia, inshallah. So if I can go through, I've got a few slides, probably. Yeah, thank you. I will need assistance with the slides here. In the next 20 minutes that's allocated to me in this session, I will firstly address the perception on Islamic banking and draw its similarity with sustainability. Secondly, I will share the efforts taken by Islamic banking industry in Malaysia to advance sustainability. And thirdly, I will explain how Bank Islam embrace sustainability. Yeah, so on this slide, basically, we have been here for almost 4 decades. And the thing is, Islamic banking, despite the number of years we're here, Islamic banking continues to be known as interest-free banking model. It is deemed to be an alternative model that coexists nicely with conventional banking, in Malaysia, especially to meet the needs of our customers, especially the Muslims that demand for Sharia compliant financial services. Yeah? And people tend to associate Sharia compliant with the word prohibition. You see on the slide, what people see will be prohibition of interest, prohibition of speculative activities, prohibition of element of ambiguity, for example. However, what is more important that we need to give emphasis over here, that the underlying objective of Islamic banking really is to deliver the intended outcomes of the Sharia, which revolve around the word preservation. Islamic banking has inherent considerations that extend beyond sustainability, that include among others, being ethical, being responsible, transparent, green, and equitable, which is consistent with universal values, basically. Yeah. And in fulfilling the role of Islamic banks as an intermediation, Islamic banking has I would say, natural duty to generate positive and sustainable impact that extend to a wide variety of stakeholders, ensuring that people and planet are not jeopardized. Yeah? So I believe that Islamic banking is not merely an alternative interest-free banking model, but also a sustainable banking model that offers Sharia-based solution to deliver the intended outcome of the Sharia. So the question is, how can an Islamic bank shift the paradigm and change the narrative towards sustainability? So we can move to the next slide, please. So for information, maybe some are already aware, for Islamic banking industry in Malaysia, the introduction of value-based intermediation by Bank Negara, what we call as VBI, in 2017, has really created a common vision for us Islamic banks to embrace and drive sustainability. Yeah? VBI is basically an intermediation function that aims to deliver the intended outcomes of Sharia through practices, through conduct and offerings that generate positive and sustainable impact to the economy and also to the community and to the environment. And these are also consistent with the shareholders' interest, which is to deliver sustainable returns in the long term. Yeah? So similar to UN Global Compact and UN SDG that guides implementation of universal sustainability principles across the globe, VBI is also designed to assist Islamic banks to integrate sustainability agenda, which is derived from this Maqasid Sharia, like I mentioned earlier, in a complete and structured manner into the banking activities. And the underpinning thrust of VBI is really to provide a basis for action for industry to strengthen the role and the impact. And one of the VBI key efforts to spur the sustainability agenda in the industry is the VBI Financing and Investment Impact Assessment Framework, or what is abbreviated as VBIAF sectoral guide that was issued back in, I think, November 2019. Yeah. And this VBIAF sectoral guide was developed to guide the incorporation of ESG risk considerations in the financing and investing decision making of an Islamic bank. Yeah. And I'm happy to note that since the introduction of the VBI, it's been 3 years already, the Islamic banking industry in Malaysia has become more focused and transparent on generating positive and sustainable impact from our banking activities as an industry. Between 2017 up to September 2020, we have published this report. Yeah? As an industry, we have assisted more than 35,000 families to own affordable homes with more than 20 billion ringgit in terms of home financing. We have assisted more than 4,500 renewable energy and green projects. And this was funded through 8.8 billion ringgit of financing. And we have also collectively assisted more than 100,000 SMEs and micro SMEs with financing worth more than 40 billion ringgit. So here, I believe that VBI has the potential to be positioned as the sustainable banking framework that extends beyond the Islamic banking industry. Yeah? And similar to ESG as a framework for sustainable investment to attract socially responsible investors in the capital market, VBI can be the universal framework for the banking industry to attract value-based customers, especially depositors, who would now have wider considerations to ensure more appropriate and conscious mobilization of their deposits that becomes fund by banks. I think it is a matter of time before banking customers become more critical and in terms of how their monies and their deposits they are being mobilized by banks. And we see this as an evidence by the increasing demand for ESG investment. And we've also seen, even in Malaysia, the ousting of directors and management of corporate businesses who fail to pivot towards sustainability and these are championed by activist investors, and this trend will just continue to move forward. So that's why it is important to embed this in the banking business. So how does Bank Islam translate VBI to realize our sustainability agenda? Maybe we can move to the next slide, please. So here I will share how we realize our sustainability agenda. Now, to ensure effective realization of this sustainability agenda, we know that we need to adopt a whole of bank approach to adoption of VBI. So, I mean, we were part of the initial community of practitioners to champion VBI, and we started together Bank Negara back in 2017. And the journey along the way has allowed us to recognize how our actions and our solutions can be translated into values that benefit the community, that can create positive impact on the environment, that can actually bring prosperity not just to our shareholders, but to all, to our customers, to our community. Our VBI journey had inspired us actually to redefine our vision and mission. So therefore, in early 2019, we rework our vision and mission, and we do that because we want to place VBI at the heart of our business model. So we want to be the bank that advances prosperity for all by providing solutions that deliver value with the promise of assuring trust, delivering value. This tagline carries our promise of good governance, honest conduct, and ethical decision making. And having this renewed vision anchored upon VBI, it has helped to motivate our various stakeholders across the bank to work together towards the shared goals of delivering shared prosperity. The stakeholders could be from our employees, our shareholders, our corporate partners, our customers, our clients, as well as the community that we operate in. Yeah, and to advance our climate strategies and initiatives to support, I would say, an orderly transition into a greener economy, we have also started to incorporate climate change risks into our overall risk management framework. Our focus is to finance businesses with high ESG standards to ensure the long-term sustainability and creating no negative impact actually to the environment, to the society. And our ambition is to double our goal, our ESG rated financing asset in the next 5 years from whatever that we have now. So the question that we always get asked is that, by putting in this kind of higher standards, so to speak, will it limit our business opportunities? I mean, but we believe that ESG ultimately would reduce our credit risk in the longer term. As businesses, it's been proven that businesses with higher ESG score will be a lot more sustainable in the future. And because at the end, banks may face financial risk from our borrowers who default on repayment because probably that borrower may be imposed fines for their poor environmental performance and practices. Yeah, and in fact, current legislation might lead towards, bank could have negatively affected if we are seen as supporting businesses that causes environmental damage. Yeah, so therefore we seek to minimize those risks with the introduction of environmental criteria into our lending decision making. Yeah. And we also believe in getting the public to join the bandwagon. That's why we have a subsidiary, BNB Investment, that has partnered with Arabesque, a global data provider for ESG screening, to offer sustainable investment funds to both retail and institutional investors. And in fact, since 2017, our BNB Investment has been introducing various funds which meet the Sharia ESG criteria, basically. Yeah. Basically, these funds would employ S-ray technology, a quantitative data tool that analyzes the sustainability performance of more than 7,000 of the world's largest listed companies using self-learning quantitative models and data scores, basically. And in championing and advancing our green financing product in spurring sustainable practices and lifestyle, we have also been a strong supporter of renewable energy sector. Actually, Bank Islam actively supports companies involved in renewable energy sector and implement green technology solutions such as solar farms, hydropower, waste management projects, and all that. Yeah, and in fact, we currently have the highest percentage of green assets to total financing portfolio in Malaysia. Yeah, and we plan to increase this proportion from the 4% currently to 10% in the next 3 years, inshallah. And we also try to contribute towards realizing Malaysia's aim of achieving 20% renewable energy generation by year 2025. So therefore, we collaborate with Tenaga Nasional Berhad through its subsidiary G-Sparks to provide financing for solar PV ownership for homeowners in Malaysia. Yeah, so our VBI adoption has pushed us to think our role as an intermediary. You know, in a way, for us, an Islamic bank, our role is not merely as a financial intermediary per se, but also as an intermediary for the creation of social benefits. You know, especially more so and more relevant in the wake of the current COVID-19 pandemic and the recovery that is needed after this. So for a sustainable economic recovery to be achieved, it requires inclusivity so that no one is left behind, particularly the vulnerable groups. So therefore, we believe that we can do more than just providing credit and being an investment intermediation to support the economy. And for this, we also consciously go beyond merely CSR activities to champion social finance, or in our case, Islamic social finance, in order to support the third sector of the Islamic economy component, which is the social welfare, in fact. Yeah. So in 2019, 2 years ago, we established a dedicated center of social finance to champion our Islamic social finance agenda. We adopt an approach to strategically offer banking products and banking services that deliver social impact and economic return. Yeah, with the target, the underlying goal is to nurture the unserved and the underserved segment of the society, so that later on they become bankable customers from the perspective of being able to get credits. Yeah. So one example of our key initiative is Sadaqah House, whereby we set this up to address the financial inclusion agenda. Sadaqah House is actually a charity crowdfunding platform. It raises donation from the public to support high impact social initiatives. And we do this not alone. We do this in collaboration with change makers, yeah, under a very transparent and highly governed environment in a way. And basically having social finance as an important agenda for the bank, and doing it beyond CSR, we have also been able to innovate various new financial products and services, which is specifically tailor-made to nurture the unserved and the underserved segment of the society to become bankable customers for upward mobility, yeah, to enable them to realize their dreams. So what we do is that we strategically connect traditional banking offerings with social finance instruments. Yeah, I give examples like instruments like Sadaqah, Zakat, and Wakaf. And we do this to create new products and services for the target group, yeah, the underserved and the unserved. And we execute our implementation in collaboration with various parties, like I mentioned just now, the change makers. And this could be a public institution, private institution, and even civil society groups. And using this approach, we have been able to create various social finance offerings that are commercially viable, that meet the regulatory requirement, rigorous regulatory requirement imposed on us as a commercial bank. One example is that we launched Awqaf Ummah financing program in 2020 to offer a bridging financing and financing to support Waqaf property projects. We also have Hope financing with a state authority to enable Asnaf to afford home financing. We also launched unit trust fund through our BNB investment subsidiary, which is the first in Malaysia, whereby it is a Waqaf unit trust fund, whereby a certain portion of the income of the return for the fund will be channeled towards Waqaf purposes to support the privileged communities in Malaysia. Yeah, and also to address the financial inclusion, we also launched our Bangkit Microfinance back in November of last year. It is a one-of-a-kind microfinancing solution funded by donation that we collect through Sadaqah House. But this is basically a zero profit or zero interest lending based on Qardul Hasan. And the idea is to assist the unserved and underserved micro entrepreneurs for them to have capital to start a business or to expand their business. And what we do is that it's in the form of loan, because we are also helping them to build their credit track record, so that later on, once they graduate from this program, they are able to apply loans on commercial terms with other commercial banks. Yeah, and not only that, this program is offered along with mentoring and business coaching program to ensure that the business is sustainable. So these are some of the examples of the initiatives that we're able to roll out, underpinned by the belief on putting VBI at the heart of our business model. So my last slide, if you can move to the last slide, the key takeaways that I would like to draw here would be Islamic banking principles that we have currently are actually already aligned with sustainable agenda, because Islamic banking is by nature run in accordance with principles of Sharia that set a set of values based on Al-Quran and Sunnah that includes championing the causes of being ethical, sustainable, responsible, transparent, green, and equitable. And it's also consistent with the Islamic teachings that humans are Khalifa or guardian on earth. So Islamic banking must generate positive and sustainable impact. And aside from pursuing profit, which is important, we need to ensure that people and planet are not jeopardized. And the other thing that I would like to highlight here is that Islamic banking, really, with the adoption of VBI, we are not starting from ground zero in the pursuit of sustainability, because VBI is a catalyst for Islamic banks to subscribe to banking practices that generate sustainable and positive impact. With that, thank you.
Thank you, Muazzam. That was really useful. I think really shows the strong alignment between Islamic banking principles and sustainability, and that's really, really helpful. So many thanks for that. We are going to need to move on now to our break. We're on a reasonably tight schedule this afternoon, and our next speaker is due in about 10 minutes. So I will thank Muazzam for his presentation. I certainly found that useful. And to the audience, please now take a just over 10-minute break. Be back at 3:45, and we'll continue with the afternoon's presentations. Many thanks so far, and see you in a few minutes.
Thank you.
Hi, good afternoon, everybody. Just to let you know, we'll be starting again in about 2 minutes. So we'll be starting in about 2 minutes. Thank you. So welcome back, everybody. It is now 3:45, at least it is where we are, and we should get underway, particularly as our next speaker is on a tight time schedule. So I would like to introduce our next speaker, who is David Carlin, who leads the TCFD program for the UNEP Finance Initiative. He most recently managed a banking pilot involving over 36 global financial institutions on topics related to climate scenarios, climate risk assessment, and climate governance. And he'll be talking for the next 30 minutes, or just under that, I think, about how you look at sustainability risks and its main elements. He'll provide examples of sources and drivers of risks, those transmission channels, the resulting financial risks, and how you actually go about identifying, assessing, and mitigating the risks, and what tools and data are available to help do that. So I can see he's turned on his camera. Hopefully he's turned on his audio. I will hand over to David for his presentation. Many thanks.
Thank you so much. It's great to be here, and I'm really looking forward to speaking with you. And it's a terrific group you have here as well. So just to go through the work that I've done. We'll be talking a little bit about physical risk assessment in this session, and specifically the work at UNEP that we've covered on that topic. So as you've likely seen, as the questions around climate risk in the financial sector have loomed ever larger, we see that these are not just questions for a particular sector, but rather questions that go across the whole of the economy. And so in both assessing how companies need to transition, but also the manifold physical risks that they face. So I wanted to first talk a little bit about climate scenarios and how we think about physical risks in the context of the work that we've done here at the UN Environment Programme's Finance Initiative, UNEP. So the first thing I would say is that specifically the topic of physical risk can often be broken down into two main areas. The first being what are called incremental risks. These are changes in baseline conditions. So when we talk about heat waves becoming more common, or we talk about various effects that are shaped, whether an area receives more or less precipitation. These are the incremental changes that a warming world creates. But we also have extreme events, and the idea here is these are the ones that grab the headline. These are the cyclones, these are the hurricanes, the floods and fires, and the two are related in the sense I like to think of it as the extreme events are the tail of the distribution, and the incremental risks relate to changing that mean. And so what we can see is, depending on the temperatures we look at, the higher temperatures we face, the greater our risks will be for larger impacts on the physical system. And while these may not be linear, and we may not know precisely when and where certain effects will happen, from what we do understand, the more we add heat to the system, the more powerful and disruptive these effects can be. So thinking a little bit about some of the effects that we see specific to Malaysia, but also in the world as a whole, to characterize these a little bit more distinctly. In terms of extreme events, what we're talking about, as I said, are the examples of floods and storms. And typically, high levels of flooding can be not only damaging in the short term, but also in the longer term in terms of higher insurance costs, as well as also rebuilding costs and business resiliency disruptions. We also have a issue when it comes to incremental risks of these changes in the baseline having negative impacts on things that aren't directly physical, but are deemed related to the physical system. So in this case, food production. That's going to relate, of course, to precipitation, as well as to temperature, as well as to soil moisture and soil quality. And all of those factors will change as the world warms. And so there's an example of both the direct damages that we mentioned, as well as the physical manifestations of a changing baseline. So to talk a little bit more about Malaysia in particular, that as urbanization has proceeded with the heat island effect that occurs as buildings are built, certain areas have seen temperature rises that are significantly higher than the global average. And this is largely due to the fact that not only do you have a warming world, but you have more of that heat being trapped by buildings rather than by natural environment. As heat rises in these cities where a lot of work is being done, especially when it comes to work such as construction, there is significant risk of decreased productivity and health hazards from working in these hot conditions. And that is an effect that is expected to increase over time. We also, as coastal nations, have the effect of being within just a few kilometers of a coastline. And so rising seas, very often people think of, oh, something gets underwater, but that's not quite right. In the case of this, that may be true for very small islands, but it's really, if you imagine filling up a bathtub, if you add more water, when things start to splash around, more of that water splashes out. And that's the issue that happens as storms come, not only stronger storms, but even regular storms from previously. Higher sea levels mean more flooding and more damage in places that maybe previously wouldn't have experienced that damage. So sea level rise is particularly important given how many people in the country live near sea level or live near the coasts. And we've already seen some of these damages taking place through coastal flooding. As mentioned, the consequences of flooding are not just directly related to the specifics of the flood and the damage to assets, but also to the business disruption, the change in future insurance costs, as well as the questions of what is the overall effects on community resiliency. And so these are effects not just for houses and not just for cities, but also for industries as well that can be disrupted, either ones that use water or that are sited in places that are likely to experience floods. So in our work at UNEP FI, we did a number of assessments and analyses where we've put together pilot programs for banks as well as investors and insurers to explore some of the different manifestations of both physical and transition challenges. And so in our prior pilot that concluded last year, we explored different climate scenarios, so how these different scenarios have impacts on the output of temperature and climate events. We also looked at the data and methodologies required to translate some of these, what are traditionally physical or climatic systems, into financially relevant variables, as well as understanding what data is necessary in order to do this. And then we looked at how these pieces can fit into both effective internal processes for governance, as well as effective reporting in TCFD reports. So I'll talk a little bit about one of the methodologies that we developed, as well as a bit on our landscape report, where we looked at a variety of physical risk tools and tool providers. So on the physical risk side, what we had done in our first phase and second phase was worked with Acclimatize. And in that work, the real idea was to develop a approach that takes in the best science, the best data that we have around the climatic events. But again, the key for any climate risk assessment is it's really a translation exercise. It's taking the climate risk data, the physical data about systems, and translating them into economic and financial impacts. And so what we did was we looked at both the real estate as well as the agricultural sector. We also looked at energy, but in this example, I'll just show how two of these pathways work. But essentially, through both academic research as well as statistical correlations, we looked at the impacts that different types of extreme events had for agriculture on productivity, on revenues, also looking at that in the normalized period of time. How did these revenues change over time? And then also, what is the relationship between, say, agricultural businesses and their likelihood of default given some of these events? On the real estate side, we looked more from an asset perspective at how the change in climatic conditions results in changes in the asset value itself. Does that go up? Does that go down? And so the goal here was to really start with a set of borrowers that we would look at within that sector. We would then go into those correlations, those relationships between the key drivers, and then we would look to extrapolate the findings that were had onto the wider portfolio. So the idea that the change in default rate or the change in property value could be related empirically or through academic research to these events. And so what we did was we created country level profiles, in some cases, a more granular profile to provide that mapping for the sectors in question. And so when we looked at the data, we could see what the historical relationships were in terms of the connection between financial and climatic variables. In the work that we did in phase 2, we explored a number of features, both understanding the necessary data for conducting physical risk assessments, looking at heat mapping, a way of bringing a structure and scope to something that is not always as detailed of a approach, and so building out that in a more effective manner. Then we also looked at the tools that were in the marketplace, and then developed further than this a full report on the tools themselves. As I mentioned previously, those correlations are really important. The connections between, say, asset values and extreme events, the connection between productivity and extreme events. So we looked at that. And then also, I think it's often very neglected, but the opportunity side was another area that we considered. And so in the work that we did, we first did a assessment for hazard coverage. So what were the hazards covered, at what level of granularity, and what type were covered under different conditions. The full report shows a full list of the types of hazards and portfolios and tools considered. We also then, as I said, moved into heat mapping, where we looked at a few key drivers of impacts on physical risk vulnerability. Then we looked at different sectors and how vulnerable they would be to those susceptibilities. And then under the combination of those, put together a heat map that can be used both for risk identification as well as additional focus in reporting. The next piece, as I said, was not just looking at the data, but actually at the tools that convert some of these climate risk impacts into financial impacts. So we looked at what scenarios were considered, we looked at what hazards were covered, we looked at the level of analysis from a geographic perspective. Was it asset level, country level, something different? In our latest report, we also did this in a more extensive fashion. Then, as I said, we also empirically looked at correlation, so understanding how to relate different climatic drivers to traditional financial quantities, such as asset values and others, looking at the historical relationships. And then we also explored a number of approaches to opportunities, as I said. So that really provides kind of an overview of some of the assessment work that we have done as part of UNEP FI. I think what would be good now, both in the interest of time as well as I think to make it more interactive, would be to open up to questions both about the work that participants did as well as other thoughts or questions you may have around physical assessments. I know data is often a common concern. I also know that there's there's many things that we can discuss.
Thanks, David. That's been really helpful, a really good introduction to the topic, and say you have managed to keep very well to time. So we have about 10 minutes of time for some Q&A with David. So if you do have a question, please do post it in the chat for David. At the moment, I haven't seen anything come in, but so now is your chance to ask David a question. In the absence of other questions, I have one, which is, so I mean, for financial institutions, in Malaysia and the region more broadly, who are just thinking about how they start down this pathway, I mean, what's the advice you can give them in terms of where they should start, what they can look at, what's the first thing they should do? And that's often the question we get asked a lot, is they understand some of these concepts, understand the need to do something, but it can be quite daunting to know where to start. So perhaps you can give some advice as to where they can start if they haven't yet started to think about how they take forward some of these initiatives.
Yeah, it's a terrific question, because so often people will complain about the lack of data, and in certain areas and certain hazards that is more severe of a limitation than others. But the key is, as we think about climate risks, part of dealing with risk is managing uncertainty. If we had full certainty, we wouldn't have risk. We would just know what was going to happen, and there wouldn't be any real consideration other than we know that under this condition, we have to put away this much money. It would be perfectly expected. So recognizing that we often are, if not flying blind, then somewhat dealing with the world of imperfect information, means that it's really critical to start the process, because it helps you build the internal as well as client engagement processes that enable you to collect that better information going forward and enhance those analyses in order. So I often think a first step is really triaging exposures, and I think heat mapping can be an effective way of doing that, whether using an external heat map or developing one for your own portfolio, but in a more qualitative fashion, to say, have we really, in a risk identification process, inventoried what the big risks are to our portfolio? And from maybe just a simple exposure side, can we determine first what may be material? Then we can begin getting into the specifics of the data. But I think first, knowing where we want to spend our attention, I think quite often it becomes an overwhelming task to say, oh, well, we need data across all of these industries or all of these hazards, but rather to say, what are you really most exposed to? And in that truly 80-20 mold, we can get a lot of progress out of focusing on the big risks, focusing on the main areas of exposure. If you're an agricultural bank, you're going to have very different exposures than if you're one that is making residential mortgages, or if you are largely working in the corporate and institutional banking space. So these are all things that I would say are particularly relevant and important to think about. And then I see another question in the chat. If you'd like me to get to that, although also I'm also very glad to share any further thoughts. But
David, yeah,
I see one about mapping.
Please take the question. Please take the question on the chat. Perhaps I can read it out so everyone can hear it. So
yeah, that would be great.
Yeah, the one I'm looking at is say in terms of the different inventory of data based on different providers. I mean, how do we harmonise on the impact or scenario analysis in terms of baseline and stress scenarios?
Yeah, so this is, I think, one of the big challenges is figuring out how do we effectively do this in a way that is particularly sound. And I think a key consideration is what I would call incremental risks. There are always going to be risks, and so unrelated to climate, there have always been extreme events. There have always been damages that can physically damage assets or impact productivity. But what we care about, I think, on a scenario level is from that initial baseline, how do the future courses diverge from that? I think that's really the critical element that is unique in this case versus the more traditional work that people have done, and especially the insurance industry has long done when it comes to physical damages. So the question is, instead of looking backward, what is the divergence from that baseline incidence? And this is, I think, where climate model can be relatively useful, is to say, this is the increased likelihood of these types of storms. This is the increased severity. And you're going to have some nonlinear effects. It's probably beyond the scope of this conversation to talk precisely about the modeling techniques for those. But what I would say is I think it is enough to say the key here is the incremental risks and updating these parameters of frequency and severity in order to change the expected impacts going forward.
Thanks, David. And then there is another question, which I think you picked up earlier. So this is around mapping climate change risks and extrapolating the degree of impact. What are the recommendations in terms of back testing the data for scenario analysis?
Yeah, this is, I think, one of the bedeviling features of climate is inherently we are looking at new regimes. So in traditional credit analyses, we may look back at a prior crisis period and ensure that we have adequate preparations to deal with the effects of that crisis period. Whereas in climate, we are changing the baseline. And so the backward-looking data can be useful for getting a degree of scale and scope, but it's going to need to be amended. So typically, I think about it as how do we forge those relationships previously, but also how are those relationships going to change over time? And that's why I get back to frequency and severity, because I think those are the two measures. It's a little bit tougher for us to say beyond that without any historical experience what the answer will be. And I think it's always important with climate to think more in a scenario rather than a forecasting way. It's tougher to say, and for climate science, the more granular we get, so the more geographically specific we get, the more hazard specific we get, the tougher it becomes to say, in 2027 in the Atlantic Basin, we're going to see 20% more hurricanes than we did in 2020. Those kind of things, the individual variations will swamp them. It becomes easier the bigger we get, and this is why we look at a number of scenarios where we look more at the tail risk of, okay, of all of the ones we've run, these are the ones that are the most harmful, and yet we are prepared for those. And that's, to my mind, the role that financial resiliency plays, is in that kind of preparedness. And in some ways, it relates to the prior experience, but it means bending that prior experience and extending it using some of the forward-looking information.
Thanks, David. So I think you've got about 2 minutes left before you need to leave. So maybe we can take at least one more question. I've got one here around. So, I mean, how do you create confidence among bank seniors that your calculation on downside risk is credible?
Yeah, this is definitely a challenge, and I think that nobody can say what the future looks like, and I think least of all in this space, because one, it's dependent on our human action. So how much warmer it gets depends on human behavior as well as on climate feedbacks, and so you have a lot of unknowns. The key here is in being a good and effective risk manager to look at the range of scenarios, to look at what the latest science says, and ensure that you are prepared for those downsides rather than to say, okay, this is what will happen. In the same way that we hold capital when we look at our ratings out to, say, the 99.9% for economic capital. We don't expect that the 1 in 1,000 year credit event happens, but we want to be prepared for it because the downside risk is nonlinear. The insolvency is worse than the hit. And these are things that get back to questions more of traditional risk management. But I think the best way to get institutions on board and understanding these things is to express and explain these concepts and how climate risk is not a separate type of risk, but a potentially under-considered existing risk to your credit, to your market, to your operational risks. And so how does it weave in? How does it fit? Those are really the key ways to, I think, get buy-in, is to have the understanding that this isn't a new exercise. It's one in the same way that post-crisis, perhaps we didn't realize some of the contagion effects, we didn't realize some of the house price effects. Now we do, now we model those regularly. This is similarly, to my mind, a wave, not just on the social side, but also in terms of how we manage risk.
Thanks, David. And I'm now aware. I mean, that brings us to the 4:10, which is the time you said you had to leave. So I won't keep you any longer because I know you have another engagement to get to. But I will just say thank you for your time this afternoon. That's been, again, a really helpful overview of the work that you're doing, and I think have been, judging by the questions we've had through the chat, has been insightful and useful for the participants. So thank you very much, David, for joining us. So I know you had a tight schedule. Thanks for finding the time, and have a good afternoon.
Absolutely. Thanks so much, Russell. It was great to be here with all of you.
Right, thanks. So for the audience remaining, we will move very shortly on to our next speaker, which is Antoni Ballabriga. But I would just like to answer one question that's come up on the chat a couple of times. That's about the participants getting access to the presentations. All the presentations that have been given over the 3 days, so today, tomorrow, and Friday, all the participants will get access to those, and you'll be notified early next week of how to get hold of them, because we will hold them centrally and give you access to them. So we won't be sending them out individually, but say you will get a notification next week as to how to access both the presentations and the recording of the sessions. So thank you for that. So we will now move on to our next speaker today, and taking a slightly different angle of sustainable finance, moving away from a particular focus on climate and starting to look at some other issues related to sustainable finance, and in this case, financial inclusion. I'd like to welcome Antoni Ballabriga, who's the Global Head of Responsible Business at BBVA. He reports directly to the board, and his mission is to ensure that people are systemically placed at the decision-making process, in the decision-making process. So he's going to talk about what financial inclusion is, what's the problem with normal banking products and services, and why we have underserved and unbanked populations, and then share examples of products and services that have been developed and he's seen others develop, and how they are different from normal banking. So I'm really looking forward to your presentation, Antoni. Thank you for joining us, and I'll hand over to you.
Okay, Russell, can you hear me well?
Yes, we can.
Okay, so well, thank you very much for the invitation. Congratulations for the conference, and good afternoon to everyone. I suppose that everyone is keeping safe at home. I'm speaking from Barcelona, from Spain, And well, as you said, Russell, this session will be focused on social topics, especially on financial inclusion. Two of the major challenges that we have as human beings, climate change, natural capital, but also inequality. And financial institutions, we have a key role to play, to create opportunities for everyone. And so that's I'm really proud to share our lessons learned on this journey, to embed, in this case, financial inclusion into our strategy. So I will try to see if it works well on the slides. Let's see. Yeah, perfect. That's the presentation I'm going to use, and that will be shared. Well, I am, apart from a global head of BBVA at BBVA for responsible business, I have been working for the bank for the last 14 years. I also have the privilege to co-chair the Global Steering Committee at UNEP 5, representing the European banks, and also I have the privilege and the honor to chair the Sustainable Finance Working Group at the European Banking Federation. So I'm going to use some examples and some insights that I also have been learning personally on the recent years around financial inclusion. So the agenda for today I would propose is, well, these 4 topics. First, how we could define and size financial inclusion gap, and the second item I want to cover is how we can link and embed financial inclusion into banking strategy. The third item will be which are the main actions and challenges that banks are having when we decided to promote financial inclusion. And finally, I want to share, well, our particular journey at BBVA. Where we have some experience on financial inclusion that can be interesting to share. And obviously, at the end, we will have time for Q&A if there are any comments or questions around this. So first, let me introduce BBVA. We are a Spanish bank based in Madrid. We have a strong presence in 25 countries, especially in Spain, Latin America, and also Turkey. We are a bank with close to 80 million customers and more than 120,000 employees. Our bank is focused on retail activities. Practically 80% of our portfolio is retail banking, 20% wholesale banking, and also it's very relevant to let you know that we are practically 60%. Our 60% of business are focused on emerging countries, emerging markets. So we are a quite diversified institution, and financial inclusion. We have not only the experience on developed markets in Spain and in US since the last month of April when we saw our franchise there, but also in emerging countries. So how we can size? Well, let's share some data that probably you know quite well. Obviously, that according to the World Index database from the World Bank, that every 3 years they release a report about financial inclusion. Well, the last one is from data from 2017. We expect to have a new report quite soon. Well, I think the data is here. Globally, we still have 1.7 billion of adults unbanked. Yet 2/3 of them own a mobile phone that could help them access to financial services. So digital technology could take advantages of existing cash transactions to bring people into the financial system. The good news is that according to this database, around 1.2 billion adults have obtained an account since 2011, including 500 million since 2014. So between 2014 and 2017, we have included this practically 600 million customers access to banking account. So everything is running fast, but although the share in adults today is 69%, in developing economies, we have only 63%. And while in some economies account ownership has surged, progress has been slower elsewhere, often held back by large disparities between men and women and between the rich and the poor. the gap between men and women in developing countries remain unchanged since 2011, no? At 9% points. So there is a clear gender gap on financial inclusion. In this, with this data, digitalization, we see that is key. For example, paying government wages, pensions, or social benefits directly into accounts could bring formal financial services to up to 100 million more adults globally, according to the Wealth Index database, including 95 million in developing economies. And there are other opportunities, no, to include more and more through digital payments. For instance, for those adults that work in private sector that are paid in cash only. So there is huge opportunities through digitalization to accelerate this path, no, to include everyone in the financial system. But beyond individuals, access to finance is a challenge, for also for SMEs. In fact, is the second most cited obstacle facing SMEs growth. No? According to the IFC, or the World Bank, practically 65 million firms or SMEs, practically 40% of formal micro, small, and medium enterprise in developing countries haven't met financing needs. No, so there is a gap not only for individuals but also for SMEs and micro businesses. So this is the target that we want to upfront with the financial inclusion challenge. No, but what at the end of the day, which are the drivers that define this lack of access, and also what drivers define the vulnerability in this access, no, to financial services. No? I am used here the UNEP guidance for financial inclusion and financial health target setting that was released only 1 month ago. That defines well that obviously there is a key factor, which is low incomes customers, but there are also a large list of other factors that condition this level of vulnerability and access to finance. And these key drivers of vulnerability, health, obviously, life events that also condition resilience, education and capability, digital and financial access, and obviously culture and other demographics. So the most important point I would like to raise on this topic is that in financial inclusion is quite more difficult to understand the challenge that we have, that other challenges, because we have a multifaceted approach to financial inclusion. There are a lot of different factors that can condition why a person can, or a SME can be out of the financial system. So it requires a quite holistic approach to overcome this situation. So, but the point is how this topic can become a key strategic driver for a bank. There are a lot of successful stories in the market, but we still to do more. When a financial institution can use financial inclusion as a key driver in their strategy, and I would like to share some lessons learned, on this journey, So the first one is that well, to understand that financial inclusion is a cross-cutting area, contributing to a lot of different SDGs, especially obviously on the primary ones that are linked to poverty, SDG 1, or the SDG 10 with reducing inequalities, or SDG 8 with decent work and economic growth. But also on a secondary level, financial inclusion can contribute to other key SDGs, obviously education, gender, sanitation, responsible consumption, climate, and communities. So this is the reality. Financial inclusion is very transversal and very impactful area where a bank can contribute to the SDGs. But I would like to share also a very interesting insight that we have learned. Trying to align our strategy, our banking strategy to SDGs. Is to use the SDG framework not only as a nice framework to report and to see where we have contributions, but to use the SDG framework as a tool, as an input for your strategic review, and to define where you can have greater business and create more opportunities for our clients. So I would say that the shift that we have to do at the strategic level is to use the SDG framework not as an export tool to report, but as a ex-ante tool, no, to define where we want to create more value for our customers and where we want to create impact. So I think that's a very relevant point. Obviously, also that applies to financial inclusion. The second recommendation, the second lesson learned is that as banks, we are fortunate because we already have now the right framework to develop, to align our strategy to the sustainable development goals, to societal needs, and obviously also to promote financial inclusion. No? So as you may know, UNEP 5, together with 30 banks, developed the principles for responsible banking. They were launched in September of 2019. Today, we are practically 230 signatories from 69 countries. Practically 50% of the banking system is committed. And with key 6 principles that helps banks to make this journey, no? Of embedding sustainability into a strategic agenda. No? And obviously, it comprises how to realign, how to measure an impact, how to engage with our customers and define solutions, engage with our key stakeholders, evolve our culture and governance, and obviously report and transparency. I would say that there are 3 key steps on the principles that can be very, very relevant, no, to implement this approach. No? One is the impact assessment. So we have to start to see where we have material impacts, and the second one is to, in those areas we have more material impacts, focus on those areas to define specific targets and action plans to from those impacts. No. And the third one, obviously, is to embed this into all governance, all strategy and plans, and at the end, report accordingly. No? This is the approach that banks that want to promote financial inclusion, I would suggest that should do. No? Instead, take into account the impact we are having, and then try to define targets and plans in those areas with highest impact. In our case at BBVA, we have done this impact assessment, and in our case, we have 2 areas of greatest impact. One is climate, and we have obviously another story talking about how we approach climate, and we have just signed the Net Zero Banking Alliance in the launch of this alliance just 2 months ago. But also we have defined that the one area of great impact is inclusion. No? And that's the reason why financial inclusion is a key topic, is a key area for us in our strategy, as I will explain later. No? But I think this framework is very useful to define how can a bank can leverage and can understand the more relevant impacts, and especially on financial inclusion as well. No? And one of the key components and the third lesson learned and recommendation embedding into a strategy is the guidelines I mentioned before about target setting in financial inclusion. So one of the works we are doing at UNEP 5, together with the 350 institutions that we are there, and 50% are banks, is developing frameworks and tools to help banks in this case, no, to embed sustainability. And in the case of financial inclusion, we have at UNEP 5 we have launched these guidelines to help banks to define their targets and the areas of impact, and define the strategy on financial inclusion. I would recommend for all banks attending that if they want to make a little bit more, to explore how they can evolve what they're doing, I would suggest to use this guide that is available online. It defines a framework to focus on financial inclusion and financial health. Also define which are the enablers and indicators, and also propose specific steps to define targets, no, for the banks that want to embed financial inclusion into their strategy. Because at the end of the day, if you want to embed a topic, in this case financial inclusion, into banking strategy, you need to define at the end of the day those key KPIs, no, key metrics, and define targets that will be at the end of the day embedded into action plans and translate it into day-to-day business. No? So it is important to have this target set, and well, this is a guidelines that can be very useful. So I enter now to the third point. Well, before to enter to the third point, pardon, we have here also in these guidelines, you will have the opportunity to see some examples of targets on financial inclusion that some banks are doing, are having. Here in the slide, you have some examples, some links to access to account or links to financial education. Sometimes number of people with access to accounts sometimes is a finance mobilized. That depends on each case, but you in these guidelines we will have even a table with different metrics that you can use to define targets on financial inclusion. And here also there are some good practices in that report that can be very interesting to share. I highlight here two of them. One is Westpac, where they have very interesting accessibility and inclusion plan focused on disabilities, especially with an holistic approach to this segment of vulnerable people that have problems to access to finance sometimes. And also another good practice is Standard Bank in South Africa and in Africa with well, a very interesting approach, a global approach to financial inclusion. So, but which are the main challenge and actions that the bank can promote to move on financial inclusion? We understand that this is financial inclusion is a collective challenge that banks can play a role, but governments are key, obviously. National strategies on financial inclusion are critical, but now I'm going to focus on the role that a bank can play. So, and I'm going to talk first about the what banks are doing or we can do. So which type of solutions can promote financial inclusion and financial health. Here in this slide, you have six general ideas that are being implemented. One, obviously, is banks can develop new products, so develop new solutions targeting for specific customers. That's the case, for instance, as I said, for Westpac, for specific clients with problems of disabilities. Digitalization, obviously, develop digital solutions, easy to use digital accounts, design digital apps for specific needs. Well, this is the experience that we have, very interesting at BBVA. We are a very digitalized bank. We have an easy to account in emerging countries that are being used by close to 1 million customers. And to give an example, obviously, to digitalize not only solutions, but also payments and on the specific needs. Due to the COVID, for instance, in Peru and Colombia, there are some, we have used the pensions, well, the payments done by the government for special aid for the COVID to make them digitalized, and provide access to a bank account on digital to 150,000 new customers. So that's the way we think it works. The third area we can work on that is on financial education. Later we are going to share our experience on that. It's also very relevant because we have to provide responsible access to financial services. So it's important to see how we can develop financial activities, financial education activities with our clients and obviously the wider society. Also, another tool that, or another way to promote financial inclusion about our solutions is obviously defining specific pricing or access to account. Later, I will share the experience that we have at BBVA, but for instance, CaixaBank, which is our colleague bank here in Spain, they have a social account that is free of charge for certain type of customers defined with certain thresholds. So that's also quite used. Also, bank correspondence is also quite popular, for instance, in Latin America, to provide access to financial services in rural areas. So agreements and partnerships with retailers and with other companies that can help banks to arrive to the last mile. So that's another way to promote financial inclusion. And finally, advisory services, because financial inclusion, it's important, as I said, to make it responsibly. So it is critical to provide advice to avoid over debts and how to overcome these situations. I would say that in this area, the most relevant challenge, I think, for banks, at least for our experience, is that debate about pricing models and entry costs, no? That normally generate. The fact is that normally generate these entry costs more inequality, no? Because they tend to charge more and pay less to those who have less. So it's a key dilemma that is not easy. Later I will share our experience in Mexico, but this is also very relevant because sometimes, well, we say, well, it's not profitable to serve certain customers, and that's a dilemma that has to be overcome in some way, no? The second area of challenges and actions I would like to share is about the how, no? About the internal processes that we have to have in place, no? So there are areas where we have to, if you want to embed financial inclusion into our strategy, we have to work with risk, obviously, to see how we can, well, to develop specific models to avoid, for instance, discrimination. Now, for instance, advanced analytics provides and artificial intelligence provides a great resources to develop new models, but there is a risk of discrimination depending if you use certain variables. So it is critical to ensure that your risk policies and your risk models don't use certain variables to discriminate clients, and to ensure how we can have a specific approach for these segments, no? Otherwise, it will be difficult, no? Also, it's very critical to have standards and data to know exactly when we have a vulnerable customer in front of us, or how we can get that information from our clients. This is also very, very important, no? Also, a very important task is about culture and training. We see that that is very critical in order to, if you want to have a bank that really have a positive approach to our customers and to promote financial inclusion, you have this in your areas. I mean, for instance, at BBVA, we have embedded sustainability as a strategic priority. We are now training all employees on sustainability, and including also financial inclusion, and that's a very critical aspect. Also, in compensation. Compensation should take into account financial inclusion if you want to promote that, and financial health. In our case, for instance, apart from the non-performance score that we track from our clients as a non-financial KPI for our compensation, we also track financial health of our clients, and this is included in our variable compensation. And also, we have sustainable mobilization as a KPI in our compensation, no? And this includes obviously mobilization to financial inclusion segment. So this is critical also to drive, no, this movement, no? And another point that we can act is around clear information and accessibility. That is very absolutely critical also to provide transparent, clear, and responsible communication. And this is also very relevant because we have to adapt our communication to the specific needs of these clients, and to use plain language. So this is also an area where we need to adapt and if you want to include more and more in our customer base, no? And finally, sales protocols, because also we have to define specific sales protocols for this type of different clients, no? And try to embed this idea of design for all from the beginning, no? So I would say, to summarize, that one of the main challenges on internal processes is how we define, identify these vulnerable customers, and how we can, let's say, develop a smart business appetite to embed financial inclusion into the strategy. You know, so depends in that this type of activities are critical to ensure an holistic approach to financial inclusion. Otherwise, it will be only a tactical one for a specific segment, but not the one that can be a value for the business in the medium term. No? And to conclude this point, obviously the third area of action that banks we may have is obviously all related to stakeholders engagement and partnership. No? As I said before, the responsibility to promote financial inclusion is not only for banks. Banks play a key role, but governments play a very key role, and all organizations play a key role, no? Providing basic services that we can partner with, no, in terms of on health, on utilities or power or others companies, water, that we can partner with them in order to provide financial services, no, all together with other services, basic services. So it's the partnership approach is really critical. So we see that banks have to collaborate with other with governments on the national strategies. We have to set partnerships with others to develop methodologies to measure the impact we are having, and at the end of the day, to promote this topic as a public policy topic. No? So this is very relevant. Otherwise, it is very difficult. No? And the last one I want to share is our journey at BBVA, our experience at BBVA. Well, let's say first that we consider ourselves as a purpose-driven bank. Our purpose is to bring the edge of opportunity to everyone. So, as you may see in this sentence, we have inclusion at the core of our company, no? So we want to create a positive impact in people's lives, enterprises, and society as a whole. And this idea of creating opportunities is what we understand that is our purpose. No? We have a strategy that was reviewed just 1 year ago. And we have, although we have been working on sustainability and financial inclusion for a lot of years, as you will see later, we have put sustainability at the core of our strategy. And so one of the 6 strategic priorities we have now is helping our clients transition towards a sustainable future. The second one is financial health. And then we have 4 more, but these are the 2 ones that build our value proposition for our clients. So we have understood the SDGs challenge and the climate transition as a huge business opportunity. I would say that for us, we have defined that is probably the best or the most important business opportunity for banks for the next 10 years, because there will be a massive shift in value between activities and other activities, a huge amount of investment to be done, and we have to help our clients to make the transition, all our clients. And so that's the message that we have important. No? But in this holistic approach to sustainability, we have defined 2 focus areas. One is climate change. I don't want to spend time on that, but obviously this is one key area. But the other one is very relevant, no? Which is inclusive growth. So we cannot understand the climate transition without, or the nature transition without an inclusive growth and not leaving one behind. No? And inclusive growth includes areas where we can create a lot of opportunities. One is financial inclusion. The second one is support financing on financial inclusive infrastructures, especially in emerging countries, and obviously support for entrepreneurs, which is also linked to financial inclusion. No? So these are the let's say our compass, no? And we have a specific target on sustainable finance mobilization, which is 100 billion euros. So from 2018 to 2025, during the first 3 years and 3 months, we have already mobilized 59 billion. 12% of this amount is on financial inclusion and entrepreneurship. It is true that it's not the most relevant figure, but beyond that, we have also the access to financial services to a lot of people, and that's the future we are building. No? So this is the target that we have. Our plan is to update this target this year because we are working quite well. And financial inclusion is part, obviously, intrinsic of the strategy. No? Focusing on financial inclusion, what we are doing now is, well, defining a more strategic approach to those customers that we think that are vulnerable and that have some challenges to access to financial services. No? And we are defining our internal, let's say, taxonomy or catalog to say, well, which are the factors that we are going to tackle and to follow from our clients, to define the specific needs that our clients have. So for individuals, we have defined a taxonomy based on income, based on location, depends on the zones that they live in rural areas or zones that have suffered disasters or emergencies. And then all the vulnerable factors that are, well, quite well known: age, disabilities, genders, migrants, refugees and unemployed. And for all these segments, we define specific thresholds to define clearly, identify clearly the clients that we have in that segment, and also different solutions, no? A map or a matrix of the different solutions we can provide them. Financial solutions, simply not financing, but simply access to account, or financial education, or we have to reinforce our transparency and communications protocols, no? So this is how the way we work, to have an holistic approach to all different segments, and to have this tailored approach for each segment, no? Depends on the specific needs. This is work in progress, but this is the approach we are having now at the bank in order to embed financial inclusion on the strategy, no? And also for entrepreneurs, no? We have to find entrepreneurs and micro business as those that we want to provide access to finance. Obviously, entrepreneurs, we define entrepreneurs up to 3.5 years as a company, but also we include here micro businesses, no? That we define in each country the size that we consider that may have some challenges to access to finance, no? We have some successful stories. We have successful stories in Mexico, in Turkey, in all countries. Here I share with you some data about, for instance, in Mexico, as I said before, we have seen that reducing our commissions and our entry cost, we have increased significantly our customer base, no? And we have provided access to account to 1.2 million customers in the last 2 years, no? So that's important lessons learned. So it pays off, no? So that's what we have learned in Mexico. Also in Mexico, we are seeing that thanks to digitalization to SMEs and providing a specific platform to SMEs, we can speed up on access to finance to a lot of SMEs with Banca de Barrio. Or in Turkey, we have a specific program for women entrepreneurs, no? We have issued a gender bond with IFC, no? To provide loans to women entrepreneurs, and well, you have some fears, no? Also, we have some experience in financial education, as I said. We have a strong plan, very robust plan that we start in year 2008. So on the last 13 years, we have invested more than 90 million euros in financial education, in programs that have impact to 29 million people in our footprint, including not only programs to society with workshops, digital workshops, tools, but also integrating financial education in customer solutions. That's very important in order to use that learning moments, that teaching moments, no? That teachable moments that customers have when they interact with us, and also promoting financial education as in public policy, no? We have a Center for Financial Education Capability that I invite you to see because we have been engaging with different institutions, OECD, World Bank, and other institutions to promote financial education worldwide, no? And the last topic I would like to cover on the presentation is our experience through the BBVA Microfinance Foundation. We decided in 2007 that we want to make a huge contribution to vulnerable entrepreneurs, no? And we decided not to create a specific division at the bank, but to create a specific foundation, a specific entity that after these 14 years is delivering services to more than 2.6 million clients, micro entrepreneurs in Latin America, with 7,000 employees. And we have provide loans for more than $15 billion on the last 14 years. Today, we have practically 800,000 clients with microcredits on average 1.3 $1,300. 84% of these customers are vulnerable entrepreneurs that have some small businesses developing. 60% are women, 30% are in rural areas. And I have the privilege to say that this institution has been recognized as member of the ECOSOC from United Nations, has been recognized as the second largest philanthropic institution supporting international financing for development, according to the OECD, no? In these countries, Colombia, Peru, Dominican Republic, Chile, and Panama. So it's a great successful story. And one of the key deliverables that we have is that we measure our impact. We say we measure what really matters, no? There is an impact report that we produce every year I invite you also to use it, because I would say that probably is the best impact report on financial inclusion for micro entrepreneurs from a private financial institution worldwide, where we have a lot of data from our clients to how we impacting in their lives and how impacting in their businesses. No? Here only you see that our clients evolve in inequality reduction, leaving the poverty line once they stay more years with our microfinance institution. So we are helping our clients to leave poverty lines. Also, we are helping enterprises to grow in terms of assets, in terms of sales, in terms of incomes, but also we measure the indirect impacts that we have in terms of jobs created, in terms of clients that have improved their education or have improved their living conditions. So it is really, really amazing, the story that we have there. And we are very proud to upfront, because we decided to say that we think to have a specific business model, not for profit, but business model, to upfront this huge challenge of micro entrepreneurship in Latin America. And that's all. And now I'm more than happy to answer your questions or comments. Thanks.
Thank you, Antoni. Again, another really good presentation. I certainly found that helpful and insightful. So many thanks for that. And we do have about 5 minutes before our next speaker, so there is a opportunity for a couple of questions. So excuse me, there is one that's come through on the chat that I'll read out so that everyone can hear it, and hopefully we can get Antoni's thoughts on this. So the question is, do you foresee a total, and I have to try and get my say this correctly, democratization of product features? So in light of the digitalization trend, and that banks, including those fintech banks and digital banks, will have lots and lots of different customer behavior around which they can tailor their products.
Well, yes, I mean, I agree that obviously there is a huge transformation on digital on financial services through digitalization, and we have seen that today it's possible what we imagine was not possible just only a few years ago, no? And this access to account through digital devices. We have seen also with the crisis that digital payments has grown significantly in our footprint, no, and we see that this is absolutely massive, no, opportunity to democratize. And the idea is that the responsibility of a bank would be to universalize, no, the access to financial services, no. So that's our ambition, no, and so without the digitalization, that's not possible. And I would say that, well, thanks that digital devices are practically everywhere, that is very powerful. Obviously, we have to see how we can partner with others to make it happen more faster and well. Obviously, new fintechs are also working on that, and we are partnering with them in certain areas, and not only on the front with our clients, but also on the back, using different partnering with other different fintechs to develop new ways to measure risks in this segment, and to provide solutions, no, to those segments. So yes, I totally agree that this will be a key trend. No?
Thanks, and one final question. I think this will be the last one. So, how long did it take you to drive the financial inclusion journey, and to get all of the stakeholders buy-in?
Not easy. I mean, I have to confess that when we start on the 27, for instance, this microfinance foundation was a very relevant step, not to say how to do it. No, it is better to have a business line in the bank that later will be conditioned for everything, or better to separate, create from scratch a new venture, no? And that was a decision that was taken at that moment. Probably if we hadn't taken at that moment that decision, maybe the impact that we are having now through the microfinance foundation we were not there, no? But the point is that it takes time. I mean, we spent practically 15 years working seriously through the microfinance foundation and also through the bank in this country, and we have to make a lot of mistakes and learn a lot. I mean, when we have learned in the past that in some countries, if we provide access to account, but you don't have your digital devices and your digital solutions solved, maybe you start to understand that you have a cost to service for a client that it will not pay off, and then the business case it doesn't work, no. And so you have to take time to make it on the right way. Otherwise, you are going to stop with the process, no? And because maybe you can say, okay, I want to include everyone, but if you want to have a branch and everybody comes to the branch, so I think you have to work hand in hand, financial inclusion with a robust solutions on digital. Otherwise, it will be not possible, no? And it takes time in terms of external stakeholders. It is critical for our positioning in emerging countries because regulators come and ask us to do more and more. So that's very relevant for the institutions, for the legitimacy and license to operate, no? But also it's critical internally because it is not something that it pays off immediately because the amount mobilized in terms of financing will be very small. So you are creating the clients of the future, no? And so it's something that you have to understand more and more medium long term, although you can have targets from now, no? That's what I could share.
Thank you. Thanks, Antoni. Again, very good insights, and thanks for taking those questions. Excuse me. That does now bring your session to a close. So thank you very much, Antoni, for joining us. And please do enjoy the rest of your day.
Well, thank you very much. You're welcome. Keep safe. Thanks.
And so for the audience, we now come on to our final speaker for today, and I'm very pleased to welcome Todd Stevenson from Colonial First State. Todd and his team are responsible for what's called the end-to-end member experience, the digital strategy, data office, and analytics, and business intelligence, member advocacy events, and human-centered design. Sounds like a very broad set of activities that your team carry out there, Todd. Todd's going to talk about particularly around vulnerable customers and associated challenges. So I can see he's put his camera on. Hopefully his audio works, and I'll hand over to him for his presentation. Thanks very much, Todd.
Thank you, Russell, and just making sure that you can hear me. I'm hoping so.
Yes, I can hear you.
Yep. Excellent. Okay. Good afternoon, everyone, and thank you for dialing in or joining. So as Russ mentioned, I'm going to talk you through more from a practical perspective. How do we help vulnerable customers manage in effect, their superannuation or their pension? So Colonial First State in Australia is one of the largest pension providers. Actually, in fact, we're the largest pension provider outside of the Australian government. So we manage retirement savings for 1.1 million Australians, and we manage about $150 billion of assets. And so of those 1.1 million members that we support and work with, we acquire them in a number of different ways, whether that's direct, via a financial planner, or via employers. So we've got a real diversity of customers, from everyone that's 17 years of age and starting out their job, up to individuals that are well over 100 and receiving a pension. We deal with high net worth individuals, as well as those in less fortunate circumstances. So to give a bit of context about the business before I jump into how do we identify and then manage vulnerabilities. And hopefully I give you some practical examples. Like Antoni, the presenter before, it's a journey. I know that's an often used statement, but it takes time. It's not something that you can rush. It is something that we've only recently started, so we're not certainly stating that we've got this nailed. We're learning as we go as well, and hopefully what I share with you is some practical examples. So I'll start with how we identify vulnerability or vulnerable customers. And so in effect, the general principle, or what we're trying to achieve, is give every one of our members the equal opportunity to access and utilise their superannuation or maximise their super. So we believe that everyone should have the same opportunity as those in less vulnerable circumstances. And so what we've done is using both legislation, competitor scans, etc., come up with a definition of vulnerability that I hope you can see here on the screen. But in effect, it breaks it down into a number of different key circumstances that are both personal, situational, or structural. So as a result of the systems, they might be experiencing some level of vulnerability. And then within each of those categories, you can see that there's individual categories or circumstances such as addiction, and that can be addiction in any category. Cognitive impairment, and as I mentioned, we have quite a large base of customers in the pension stage, so they're over 65 and decline, also aging. And as you can imagine, as they age, sometimes their mental capacities decline. We have people that are very disengaged, so I'm sure like your industries, you've got groups of customers that are defaulted into you or just come to you in many ways. And as a result of people not actively choosing to work with us, they're put there by their employer. There's not often a lot of engagement. Here in Australia, the pension system is mandatory. So you don't actively have to choose to do anything or engage. In effect, if you do nothing, often you can be well looked after. Indigenous, LGBTQ, IQA, actually life stage. So again, depending on the stage of life people are at. Non-English speaking, Australia has, I think it's about 40% of all Australians were born outside of Australia. So massive diversity of languages here in Australia, and often the services that we and other financial institutions provide don't accommodate as well as what we should for those. Physical and mental impairment, and then of course over in the situational. So an event might happen in someone's life where they're the victim of domestic and family violence, disaster, and we've seen that certainly here in Australia lately with things like fires, floods, etc., and that can actually have quite a significant impact on their financial circumstances. So you can see here that it's quite a broad definition. Some of these, and I'll go to the next slide, some of these things are really easy to identify, and some of them are actually really hard. You know, in your database, it's really easy to see someone's age and therefore what life stage they may be at. You can certainly see their wealth in our systems. We get proxies for their income, so you can see those types of statistical information and data. You can see how often they log into our digital systems or engage with our call centres, etc. But there's a lot of these circumstances where you can't see it instantly, and so people either need to self-identify, or using your analytics and data, you might be able to imply one of these vulnerabilities. And that's a really interesting space around using your analytics, because once you've identified that someone is vulnerable, what do you do with that information? You know, how are you sure? How do you surface that to that individual? And I'll give you an example. In terms of cognitive impairment, Colonial First Aid is owned by the CBA. The CBA is Australia's largest bank, second largest company in Australia, employs 50,000 people, and I think has a market share of about 40%. In our data and the analytics with the bank, we can often identify where someone's cognitive load is declining. And so an example of how we identify that is someone might pay their all of their bills on time and has done so for the last 15 years. And then all of a sudden we see that they're either starting to skip bills, or they might have paid the same bill 2 or 3 times, not remembering or recognising they've done it in the past. And we've worked with Harvard Star Labs to actually build these models to identify where people are starting to lose these cognitive abilities. But the real challenge there, once you've identified it, is what do you do with that? How do you surface that? Do you surface it to the individual? Do you surface it to someone in your branch network or a customer-facing individual and get them to have the conversation? Or do you surface it somewhere else, such as to their family or friends? But how do you do that without breaching privacy? So this is quite a new space around using your analytics to identify vulnerabilities. There is that component of identifying, but then what do you do with it? It's a really tricky one. And so, as I said, how do we start by identifying the customers and their needs? I think it is really important to recognise that it's really hard and challenging work. but it is some of the most rewarding work. What we see with our staff that work in this vulnerability space is that they are some of them motivated and some of the most engaged across the entire organisation. What we find is that it's not about making money for the company. It's not about making profit. It's not about driving, massive amounts of change. What it's about is helping individuals, getting that reward of helping that person that's called us that really needed our support in that moment. And that could be here in Australia, as an example, your retirement savings are preserved until you reach retirement age. So you can't access them before age 67. However, there are some circumstances that allow you to take part of that money out. And that can be where you've either been unemployed or you're the victim of certain vulnerabilities, such as domestic violence and abuse. And so working with the victims and actually getting money in their hands so that they can actually, move home or set up a home for their family and kids, it's so rewarding for the individuals. And then those stories spread. And so I think it's really important that you look at these as, it's the right thing to do for your customers. It's the right thing to do for your staff. And if you link the investment into these capabilities around your purpose, then that drives, real change rather than just a commercial business case. So I think recognising that this is hard work is important, but it is rewarding. There's obviously the reactive identification of vulnerabilities. So we will get people that call us and self-identify that they are victims of domestic violence, that English is a second or even third language. And in those circumstances, it's relatively, I wouldn't say easy, but clear that they need help and support. In terms of the proactive, where we have to use our data or segments to identify individuals, that becomes certainly, as I said, much harder. For certain segments, you can identify groups or cohorts. We can identify that a third of our customers are over age 65, or we can identify that certain individuals live in certain areas and those areas themselves are have certain demographics, and that might mean we need to do different types of on-the-ground education or servicing in those spaces. But when it comes to individual identification, I go back to what I said before, identification is one component. It's then what do you do with that? The other thing to call out and recognise is you can't be all things to all people. So if you go back to those 19 segments, we can't build capabilities to address each of those needs. And so what you need to do is really build out your specialist networks. It's not fair or reasonable to expect that your frontline staff can do their day jobs, can manage a sales load, the information that they need, and then also sometimes emotionally act as a support to customers in very, very trying circumstances. So you need to help those people and build out their networks of where they can refer people to. And there are some awesome agencies here in Australia that the government set up, or privately funded agencies that we work with, where we know that if we refer one of our customers to, that they will provide a great level of service to those individuals. And that can be, as I said, either from domestic violence through to financial coaching or counselling if they can't afford advice. We also work with one of Australia's, is through the Australian government, and they provide a translation service to us where they act as an intermediary between us and our customers, and they provide language services for over 195 different languages. And that's been groundbreaking because, again, if you have ever listened to a call where a customer calls us and they can't communicate and our staff can't receive it, it is so frustrating for all, but with service now connects people, so it's really good. And then, as I said, develop referral networks, not only to refer people to, but to train your teams. These are tough interactions and tough calls for your people. So you need to show that you are supporting them as individuals in dealing with these cases. Check in with them. It's hard to expect your contact centers to take 50 calls a day. Then you load in the fact that, a couple of those or a couple of those calls might have been from, people in, with cancer, people going through terminal illnesses. That's an emotional load. So you really need to help and support your people when dealing with vulnerabilities or vulnerable customers as well. Now, in terms of building out a plan, so I go back to those that earlier slide that I had in terms of identifying key segments and then vulnerabilities. I think, like Antoni, we do actually have a roadmap that goes over the next 4 years in terms of what are the activities that we're going to undertake. And some of those activities are based on simple quick wins. that we know that we can make a meaningful difference. Some of them are built on commercial value or in terms of what we actually need to do to address it. Others, and I've got some slides, is some quick wins around getting some big actions to generate momentum within your team, and then small local actions to actually motivate individuals and people. So for us, as I mentioned, we are Australia's largest private payer of pensions, yet not one person on our leadership team or within the business has ever actually been retired or lived on the age pension. And so what we did was we put our leadership team through an experience where they had to live on $20 a day for all of their living expenses, and we did that for a week. And so they had to buy lunch, buy coffee. I don't know what that amount translates in your currency, but $20 a day here in Australia probably doesn't go too far. Probably buys you, 1 or 2 cups of coffee and a sandwich, and that's about it. And so we asked our leadership team to live off that for an entire week. And that was eye-opening because I think they started to realise how mentally consuming it is to always have to think about how much have I got, what am I spending, the fact that, if you made one mistake, you blew your budget for a week. And as a result, we now make decisions at the leadership team table very differently. We've got remediation programs, which I'm sure you do, or some of you might have in your businesses. We'd often wait, until we got those calculations perfect before we paid money out. Now we're paying out 80, 90% as soon as we can, and we'll figure out the rest 20% or 10% later because we know that $50 in the hand of someone is actually worth, so much more to them now than $50 or $60 later on. Work experience weeks are similar. We have a number of our executive teams go out and actually work in our broker or agency offices to see what that experience is like. We provide monthly newsletters to our entire staff where we educate them on the programs that we're running. We don't do that by email, we do it via video. And they're only 3 or 4 minute videos because we know that, again, people are busy. But what this does is it really breaks it down, what we're doing, a really simple, easy language. It sounds simple, but these things work. And then one of the most powerful things that we've done recently is here at CFS, we give each staff member has one volunteer day a year where they could go out and volunteer their time for a charity. And sometimes that historically has been planting trees or painting a fence at a school, etc. What we've now done is we've linked that program to our vulnerability program as well. So our people are now investing and donating their time towards our customers that need it most. And again, with engagement skyrocket as a result of people really helping our customers in new and different ways other than just with their money. And in terms of small local actions, so you do need to constantly train your frontline staff in how to deal with these matters. As I said before, we ask a lot of our frontline teams and staff. Often they're supported by technology and services and scripts even, but a lot of these cases you can't deal with via a script. It's all EQ and empathy. So you've got to constantly be engaging your teams. That requires you as individuals or leaders to listen to the calls and hear, how your members are feeling. Through COVID, we did a lot of that because people are under massive financial pressures, and it's only when you can actually experience or feel how others are feeling that you can actually really truly understand. We recognise and reward staff that not only service our members in new and different ways to help them, but we also recognise and reward those that refer and identify these types of cases. We had a case recently where an elderly gentleman was having real struggle sending us forms via email. Now, he was trying to do that and he was only about 5 kilometres away from our office. And so the individual that took the call actually used their initiative, got in a taxi, went out and actually went to his house, and instead of he emailing the forms, simply picked them up. And again, the financial reward on that for us is minimal, but the engagement and the story and the value that gets internally across our entire team that we're really there to help our customers is invaluable. And then one of the other things that we've recently done is implemented what we've called this Member Plus team. And that is an extension of our contact centre. So our contact centre deals with a lot of transactional type inquiries and calls. And typically, they are measured using typical contact centre measures such as grade of service, call duration, volume of calls, satisfaction, etc. The Member Plus team is a smaller group of individuals with almost no metricated KPIs other than customer satisfaction. And they deal with vulnerability, and they're also empowered to, in effect, don't break the rules is the right way to say it, but challenge our traditional processes and go out of their way where we're willing to risk accept some elements of process we might otherwise be able to, simply to help our members. So whether it's accepting forms via email, processing a form without an ID because we know that that individual, their house might have burnt down or they've had to flee a really vulnerable situation, and us taking on that risk of not having that ID verified. So that team has that in power. They also have the capability to send out things like food vouchers or petrol vouchers to some of our staff. Not a lot of money. I think it's about $50 that they can do. But again, it's really meaningful for the individuals and really rewarding for our staff to be able to do those types of things. Some of the challenges when it comes to dealing with these vulnerabilities, I think the first thing is you just get started. In our 1.1 million members, as I said, we identified, I think it's about 21 different cohorts, and we estimate that about a third of our members will experience each year. But if you start to go too deep into the ability, you can get caught in that without actually doing it. And so I think it's important that you just start and get going, because that will build some momentum within your business. The other thing is in contact centres, and I don't know what it's like where you are, but certainly here in Australia, I think we're averaging about 20–25% of turnover in our contact centres, and even more so at the moment because a lot of companies are either onshoring or bringing their contact centres back in given the COVID scenario situation. And so with staff turnover, that means you're constantly re-educating, constantly retraining. And so vulnerability is not something that you do once and move on. It's something you're going to constantly have to work on and help your people with. As I said, bandwidth. So I don't think that your teams can do this all on top of everything else in their day job. So I think setting up specialist teams is really important. I think it's really important to recognise that your staff might be impacted too, whether it's, and we've got a staff base of 2,000 people. Again, here in Australia, we estimate that 1 in 5 women will suffer some form of domestic abuse or violence throughout their lifetime. So if you do the math on that, you know, 50% of our staff are female, that takes to 1,000. 1 in 5 means at least 200 of our staff at any point in their life might experience some form of domestic violence. And so they too may be victims or susceptible to these vulnerabilities. So if you're helping your customers, make sure that you're also listening and helping your own staff in ways, in all ways that are possible. As I mentioned, proactive identification is really challenging. Where to help, identifying your networks is really key, and identifying those groups and agencies to work to. And then, as I said, building out a business case to invest in some of these things, particularly with your roadmap, it's important to have a CEO or a senior executive with owns budget that is either a sponsor of these things, or if they're brave enough and open enough, transparent enough, if they've ever experienced a vulnerability through their life and can share their own stories, that also builds a lot of faith, trust, and momentum and care that really matters. And often you can find sponsorship through that. And so that's the other thing is, yeah, there's so much to do, and sometimes you feel like, are you doing enough? Could we do more? The answer is yes. You could always do more, but if you get caught up and worried about that, you'll get nothing done. And so I go back to that first point about just getting started, because in 5 time or in 15 months time, you'll look back and go, wow, I achieved a huge amount. It's really important. So hopefully that is Australia. I've tried to light and give you some just real examples of what we're doing and what's worked, what hasn't, what you need to look out for. But I'm absolutely open to hearing from you guys around best practice or what works for you. But I'll pause there and take I've got some time questions as well.
Thanks. Thanks, Todd. That was again another really useful presentation. I certainly found that that was really helpful. And again, as with the other speakers, you've done great in keeping to time, which always makes my job a little bit easier. So we do have a couple of minutes remaining. So if you do have any questions for Todd, please do post them in the chat before we move on to say formally closing the session today. But say if you do have any questions for Todd, please do post them in the chat. In the absence of anything there, Todd, I had a question for you. Obviously, your experience is mostly in Australia, or complete in Australia. I'm just interested in sort of if you have any views as sort of some of the challenges that financial institutions in this region would face in terms of looking to do some of the things that the Colonial First State have been doing in Australia.
So I've worked a bit through Asia, and I think I've worked in Hong Kong, Singapore, and China somewhat. I think it is really important that you look at the cultural elements that come into these things. I think simply adopting what's worked in Australia may not work in your society. I certainly know that there's certainly different views around sexuality, family relationships, family dynamics, investing in terms of how they approach money, attitudes towards money. As I think you spoke about, the unbanked or micro-payments. One of the big things that I think is certainly an issue that I see through Asia, but also becoming more globally, is this widening between the rich and poor. The rich are getting richer and the poor are just sort of really stagnating. And I think we've got an obligation as individuals to help others. And where we're seeing inequality and inequity of the rich getting richer, I'm all for capitalism, but I think it's more obligation to help another. And I think that is a big issue, and that that is not only the responsibility of institutions such as Colonial First State. We can people where we need to speak up and support. And so I think advocacy or the institution play advocating for your customers, and what stance do you take, and do you take it publicly or do you do it privately? I think that's the reach that I think will start to emerge, and certainly something that those in Asia might want to pay as well.
Thanks for that, Todd. I mean, I think, and now we are approaching the end of the session. I think your audio is going a bit funny as well, so I'm not quite sure. I think that's a problem, maybe your end rather than our end. But I'm going to suggest we draw this session to a close, and thank Todd for his presentation. I certainly found that useful. And say thanks, Todd, and we'll move on to our final session of this afternoon.
See you guys. Bye.
Thanks, Todd. So for the audience, we're now moving into our final session and the closing session of today. And we're going to hear from Rafe Haneef of CIMB, who's going to provide a wrap up of some of the key takeaways. As we go into that, we're actually going to put a poll on the screen, which is about getting feedback around how you felt the sessions this afternoon went. We will leave the polling up on the screen on the right hand side of your screen while I hand over to Rafe to provide the closing remarks. I mean, Rafe is the Chief Executive Officer of Group Transaction Banking at CIMB and oversees 4 main product pillars across the bank. That's trade finance, cash management, security services and financial institutions, serving the group's non-retail customers across CIMB's franchise in ASEAN. He has 20 years of experience covering a range of businesses and functional roles from 3 global banks, an international asset management company, and a legal firm. And so he's going to provide us with his view of the key takeaways from this afternoon's session. Over to you, Rafe.
Thank you, Russell. Good afternoon. Assalamu alaikum. I think we had a very long day, And I think we have learned immensely from the 5 presentations today. And we have now reached the graveyard shift. And so please bear with me for 10 minutes before we say goodbye. So I would like to filter out some of the key lessons that we've learned from these 5 presentations today. I think Bas from Rabobank made a very strong business case for sustainability for banks. And what we can learn from in Malaysia, the 5 key lessons. Number 1 is having sustainability as the core strategy for the bank. So by integrating sustainability as a core business driver, we will be able to achieve a more sustainable finance for the bank. And in terms of the driver, we have seen in Rabobank that the business units are actually driving the sustainability ambitions and under the stewardship of the sustainability department. So that's a clear key driver for the bank. And in terms of the KPIs, all the managements have a clear performance management KPIs to improve, 1, sustainability standards for customers, and also increase the share of book for sustainable finance. And then he explained clearly the framework for what he called the sustainable development transition banking, where he looked at 4 pillars, which is 1, financial well-being, food and agri system transformation, circular economy, and energy transition. And in the center, Rabobank has got the sustainability department, the BU innovators, and the business units clearly driving these 4 quadrants. And finally, he talked about engaging with customers to achieve sustainability standards and provide solutions for them, working with multiple stakeholders. So Bas talked about a few customers of theirs and how they have integrated sustainability into their businesses. And by integrating these into the businesses, Rabobank will have happy clients, and the happy clients will then lead to a sustainable planet. So what we learned from Rabobank is, 1, they have an inspiring vision with a strong mission and clear engagement with the various stakeholders and cooperating with the customers and putting the right incentives to achieve the results. So I think Rabobank is a fantastic example of how sustainability should be driven in a bank. Muazzam Mohamed articulated very well about the sustainability angle of Islamic finance. He talked about the twin purpose of Islamic banking, and what we typically see, the tip of the iceberg, is the prohibition of usury, which is what's seen as the main purpose of Islamic banking. But he clearly highlighted the other angle, which is much, much bigger than the prohibition of usury, is the preservation of social good and prevention of social harm. That is what he called Sharia-based, which is fully in harmony with sustainable finance and sustainability principles. And he talked about how the central bank has developed value-based intermediation back in 2017 to create a common vision for Islamic banks towards transforming banking towards sustainability. And he gave an example of how BBVA is creating sectoral guides to look at high-risk sectors and reduce climate risk. Because without addressing the climate risk, we will not be able to promote social good, and that will be a big factor for Islamic banks to look into. And he also talked about how Bank Islam is promising to bring prosperity to multiple stakeholders. He talked about how they will reduce the footprints from an environmental perspective, and he talked about how risk management is looking at climate change risk in Bank Islam. He also talked about how Bank Islam is creating or enhancing footprints in terms of social impact. He talked about crowdfunding, Sadaqah House, to help the vulnerable segment. He talked about utilizing Waqf or endowments for economic empowerment. He also clearly articulated the growth of green financing, highlighting that 4% of their loan book or financing book is in green and social financing. And he talked about how they also promote ESG funds and investments, and also have dedicated microfinance initiatives to help the unserved and the underserved. Then we moved on to David Carlin from UNEP. He talked about how UNEP can help banks in the journey towards the sustainability framework to manage the climate-related risks. So he talked about how rising temperature leads to physical risks that could impact the bank's portfolio. And he specifically focused on physical risks and how UNEP tools can be used to address incremental risks. He talked about droughts, he talked about sea level rising, and these are increasing incidents. And if you're not able to assess, identify, and address these risks, this will lead to severe impact to both the bank and the customers. And he also talked about extreme events like heat waves, fires, and floods that could also create huge impact, physical risk, as well as transitory risk to the banks. And he talked about how these rising temperature could impact Malaysia, where in the last 20 years, the temperature has risen by 6.75 degrees over the last 20 years, and how sea level rising will impact 13% of Malaysia's total land. So all these are severe consequences that the bank needs to address. And he talked about how the climate risk toolkits developed by TCFD can be adopted by banks to formulate, to clearly identify the physical risks and come up with a physical risk assessment framework. Through, for example, he analyzed real estate and agricultural assets to see how these impacts can be assessed, identified, and clearly addressed through this framework. So he talked about how we need to make sure we have what we call the inventory data so that we can better understand the risks and come up with a methodology to basically assess and address these risks, and also highlighted the importance of having a reporting standard and governance around it. And finally, we will analyze what was mentioned by Antoni Ballabriga from BBVA. I think he raised a very important point on financial inclusion. The two key problems facing the world today, one is climate risk, the other is inequality. That's leading to various social impacts. So he talked about financial inclusion to solve the global problem of inequality. He highlighted 1.7 billion adults lacking bank accounts. He also highlighted how SME growth is constrained due to lower access to financing across many countries, including Malaysia. And then he talked about 4 key pillars. If you want to address financial inclusion issue, number 1 is we need to understand the vulnerable segment. So defining vulnerable segment is critical. So he talked about how BBVA defined this vulnerable segment by income, by location, by other factors like age, gender, disabilities, and also how they look at SME categorization, where SMEs up to 3.5 years will be considered as vulnerable, and by size, depends on the countries they operate in. So based on these segments, they will then come up with targets. And he raised an important point of how we can use SGD target as an ex-ante input in defining the output. Today is often used as an ex-post outcome or an output. So that's a different shift, and I think we should seriously look into it. And he also talked about how we can adopt UN principles for responsible banking, focusing on target setting. Because if you don't have targets, you will not be able to measure whether you have met the targets. And the second one is how do we actually ensure the impact, the intervention that we have provided is leading to the right impact. So it's all about analyzing the input, the output, the outcome, and the impact, and to make sure that the impacts have been actually achieved through the intervention provided. And then he talked about the smart target, particularly the share of book, in terms of what is the share of book for low income individuals. He talked about BBVA having 46% of bank accounts with low income individuals, and also targets for microfinance in terms of having, for example, in BBVA, they have 40% of business clients who are from the microfinance segments. And then he also talked about how BBVA has adopted digital solutions to drive financial inclusion, and how this digital revolution is helping to bridge the gap and lead to better financial inclusion for these underserved and unserved segments of the population. And finally, coming to Todd Stevenson from CFS, I mean, he addressed another unique problem facing the world today is about certain vulnerable segments. And he defined these vulnerable segments, whether they are facing enduring disabilities, or it could be events-based. So when you're tackling this kind of complex vulnerable segments, he was basically advocating, one is of course reactive, referring to the customer's needs. The other is being more proactive, using data science to predict the vulnerable segments' needs and requirements and proactively engage with them. And he talked about a roadmap about how there could be a quick win, some quick wins, using various tools like videos, live sessions, newsletters, engagements, to engage with these vulnerable segments and identify the needs and proactively provide the solutions. And he also talked about long-term value creations, how there could be a better engagement with these segments to address their needs. And the final point he made was just get started. Don't spend too much analyzing it. He was talking about, avoiding this analysis paralysis gap, a problem. And he talked about how staff training is essentials and how to proactively identify the needs of the vulnerable segments and address them in a timely manner and having a roadmap. So this is the gist of all the various key lessons that we've learned today. I think I truly enjoyed all the 5 sessions, and I wish you have also enjoyed it and benefited from it. And hopefully we could take this as lessons so that we could then improve our own roadmap towards achieving sustainability for our respective banks. Thank you.
Many thanks, Rafe. You've done a great job of summarizing what is a lot of detailed content this afternoon. You were obviously paying very close attention to all of the presentations today. So many thanks for that.
Thank you.
And we are now very close to closing this session. Just remains for me to thank all of you, the audience, for joining and staying with us this afternoon. I do hope you've enjoyed it and got some very useful insights from all of our speakers. As I've said several times, presentations from today and the other sessions throughout the 3 days of this conference will be made available to participants, and you'll get a communication early next week to let you know how to access those. I do hope, and I encourage you to join us tomorrow for the session, the conference. We'll be continuing our discussion about sustainable finance and how you can manage climate change. We're talking about Bank Negara's green taxonomy, giving tips around how to operationalize the TCFD, insights on climate risk disclosure, and more. You'll also hear from the Ministry of Environment and Water on the national agenda on sustainability and from the Minister of Finance on sustainability in public finance. I do hope you'll join us tomorrow. And if you haven't registered, you will be able to find a link to the YouTube live stream in the chat. My colleague has just posted it. You will also there find a link to the YouTube stream for day 3, and I encourage you to join day 2 and day 3. Finally, I would just say, this conference, the JC3 Finance for Change Flagship Conference, has been co-hosted by Bank Negara Malaysia and the Securities Commission. It's supported by the UK government's Low Carbon Energy Programme in partnership with Ernst & Young, and it would not have been possible without the support and the very hard work from teams at CIMB, SME Bank and Zurich, and without the very useful help and essential help from our knowledge partners, Climate Governance Malaysia, WWF, FIED Forum, Swiss Re, Fair Finance Asia, AFI and IBFIM. So I do thank you again for your participation. Hope you enjoyed today. Hope to see you tomorrow and Friday. And I now wish you all a good evening ahead.